Aluminium, pharmaceuticals, semiconductors, all because President Trump mentioned them, Guy.
Okay, here we go. Tuesday's session is almost upon us. It is time for the opening trade. Let's take a look at some early numbers and figure out what is happening here. FTSE's probably going to be the easiest one to read first. Not exactly a clear sense of direction. I feel we get this conversation coming every day. We are going to wait, I suspect, for the German market to open. Could take a little while. Took ages yesterday to get the market going. Remember, we get LVMH after the close today. That's going to be another factor for the European session as we work our way towards the end of the day. So the Stock 600 up by 0.2% of 1%. The FTSE 100 up by 0.2% of 1%. We really need the rest of the blanks to be filled in around Euro. Here we go. The CAC 40 absolutely flat on the session. Airbus could be a focus as well. Some potential big orders coming through from Cathay there. IBEX is absolutely flat as a pancake. We await the DAX and we await the SMI, Chrissy.
We certainly do, but I think when you look at the initial moves from the Stock 600, we're waiting again, as you point out, for some of those German names to actually hit and open. You are seeing kind of a tale of two sensational companies, perhaps, from your sensational six. ASML is your biggest index contributor to the upside. LVMH is your biggest index contributor to the downside. So, Anna, it does feel like a tale of two heavyweights.
And that's before we've had the numbers out of LVMH. We've had some sort of sidebar news flow, haven't we? Yeah. But we haven't had the actual numbers. They come a little bit later.
Is it a tariff story?
Yeah, maybe.
Because Trump's talking about quite significant tariffs. You could expect maybe them to be hit
mention luxury goods, but maybe handbags are not
Universal.
The first thing that comes to his mind. Yes, indeed. Yeah, Universal. So we do see some weakness, as you say, Critty, in some of those luxury names. LVMH is one of them, but we have others weaker. And consumer-facing businesses weaker. So Puma, Swatch, Burberry, all of those down by more than 2%, in fact. So there's some weakness across the board, it would seem, in that luxury space, consumer-facing space. But technology is the best-performing sector today, up by 0.5%. A little bit of a bounce in some of the names there.
We're certainly still watching and waiting for that initial opening trade on SAP as well. We know that they were priced in the positive direction on TradeGate, so we'll see if that shows up. I know just barely. The earnings came in barely above the consensus as well, so we'll see how that all shakes out. We'll bring you the live pricing, but I think the big question is, do you buy the dip from yesterday? Is that premium still juicy enough? John O'Toole, Global Head of Multi-Asset Solutions at Amundi, joins us around the table this morning. John, I'm going to put that question to you. Have the valuations come down enough in one day to make buying the dip worth it?
Good morning. One day is one day. We had some dramatic moves yesterday. Obviously, NVIDIA down, 18, 20%. That does take it back to levels where we saw at the end of September. So, to keep things in perspective, in terms of our longer-term play, we think it's a reasonable opportunity to put risk in portfolios. We think the growth dynamic is reasonable. The disinflation dynamic is still intact. So we are on the risk-on side in our portfolios strategically. Obviously, there are some extreme valuations. The S&P at 23 times. Historically, it's not a good starting point to enter a market. And historically, returns will be so low single-digit if you enter at 23 times. Valuation adjustment. Valuation doesn't move it on its own. So we've had an event. We've had this deep-seek story, and the question is this going to metastasize into something more and more of a bigger sell-off? It doesn't seem like that, but ultimately it seems to me that if this technology, which is an enabling technology, which is going to improve productivity massively, if that ultimately becomes cheaper, net, when we look through all this, that can be a positive for growth.
So you mentioned a couple of things. So you mentioned the disinflationary narrative. You mentioned positive for risk assets. Could you qualify tech as a risk asset when it traditionally feels like rallies more on a defensive bid than maybe a risk-on bid?
No, indeed. So, when we talk about risk assets, we really talk about the broader equity market, credit markets, And really, growth is slowing, and our outlook is that growth will slow to around 2%, give or take, which is not dissimilar to the Fed expectation in 25-26. With the disinflation narrative down towards 2.5%, that means financial conditions are still quite good. Credit spreads, while tight, in a non-recessionary environment, there's a huge amount of bid for credit, and we see that. So we think financial conditions are reasonable, and that can be a decent backdrop for adding to risk. Tech, obviously, has been driven. It's a super concentrated story. So we advise our clients to diversify away from that tech concentration, the Mag 7 concentration. That's what we've been doing in our portfolios, diversifying towards equal weight S&P, diversifying towards mid-cap in the U.S., which is not as exposed to Trump, is not as exposed to the tariff story. And again, we do think that this new U.S. administration will go out of its way to ensure that U.S. growth is going to be very positive. We ask ourselves, is that a bad thing? Is that a bad thing for the rest of the world? So,
okay, let's talk about the rest of the world. It's interesting you bring up the equal weight. The equal weight did okay yesterday, so the diversification trade paid off. We were talking about this a little bit yesterday. Is it, though, if I want to diversify, is it cheaper to do it through US mid-caps, small caps, or is it actually cheaper to do it through European equities or Asian equities?
It's a good point. So we have diversified across the board. Europe is trading us something like 13 times. Europe is very unloved. Sentiment is super weak. Sentiment is super weak around the European economy. Weak industrial productivity, weak labor productivity. The Draghi report about Europe having to really restructure itself meaningfully. So Europe is a pretty beaten up place. There's still some fantastic companies in Europe. They're suffering vis-a-vis US listed companies just because they're listed in Europe. So at 13 times, that's an attractive entry point. So we have allocated capital to Europe, to Japan, to the UK on that basis through the back end of last year. And again, to diversify away from this US exceptionalism story.
But is it tough to take money out of the States? This is the problem, isn't it, that a lot of portfolio managers face?
Yes. So again, another way to mitigate the risk in our portfoliows, volatility was quite low. The VIX, so hedging was a reasonable thing to do around Christmas time. So in the close into the year pre
so you bought hedges before into Christmas.
Some protection on a 3 and 6 month basis, and again that allows you to stay invested, and you pay premiums on some protection, and you can still participate in the upside.
So what does that mean, John, for your European exposure? You were saying there, Europe is unloved. Where is that negative sentiment overdone? Where do you see that we are due a bounce back for Europe? Or is it just the overall market?
Overall, European growth level is pretty anemic, in or around 1%. Now, underneath that, there are countries like Spain that are growing at 3+, countries like Germany that are basically
not growing,
and France, Italy around about 1%. But there are stories, there are strong companies at index level, again at 13 times. From a strategic investment perspective, a longer-term investor, it's a very sensible thing to diversify your equity risk in a portfolio into cheaper countries.
Does there need to be a catalyst? Do we need to see another catalyst for Europe? I mean, we started to see this earlier this month, didn't we? Some broadening into Europe. Yesterday changed the thinking a little bit, but what do we need to see?
The China growth story is a very important driver of what happens in Europe. You will have the MPC in March in China. We do believe that the fiscal impetus from the Chinese authorities will continue, and they will try and put a bottom under the Chinese growth story. That can be a catalyst. And again, we think that that's in the background, and China is going to have to protect itself from what's happening in the rest of the world, tariffs, etc. So that can be a positive catalyst. Structurally, the German election could result in a release of the debt brake. So there are a few events out there that could be possible. We think the ECB is still on a rate-cutting trajectory. We think the 4 more cuts. So again, that all provides a positive backdrop for risk-taking.
Why do you need growth in Europe to invest in European assets if the exposure is mostly in the States and in China?
Sorry, second?
I was going to say, why do you need growth in Europe to invest in European assets, given the exposure is everywhere else?
Yeah, I mean, Europe is between these two enormous trading blocks. The growth trajectory in Europe, we think, is increasing. It will improve. So
why Europe's been cheap for ages?
Yes.
Why now? What is it that now is it simply because the US is now too expensive and therefore you want to diversify?
It's a diversification trade away from the US. So if the US exceptionalism story via the Mag 7 is somewhat at risk,
Yeah.
And it's had a fantastic run. You've had 2 years of double-digit return. It doesn't often happen that you get a third.
But you don't fundamentally believe, it's not a fundamental belief in Europe, Europe's getting better. It's just, I need to diversify away from there and this is cheap.
As a multi-asset investor, so running multi-asset portfolios,
sure.
We're in the risk diversification business, so it makes sense to do that. On an outright basis, obviously we have stock pickers running portfolios. They will always be risk on in Europe. And their risk stance, I mean, they think Europe is very attractive and very appealing, actually.
Right now. Cool. Great to see you, John. Thanks for stopping by to see us. Greatly appreciated. John O'Toole, Global Head of Multi-Asset Solutions, joining us from Amundi. Let's talk about some of the stocks that are on the move here in Europe this morning. We've already mentioned what is happening maybe with the luxury sector. Remember, LVMH reports a little bit later on today. We're going to get that after the bell. It is, though, lower, down by around 0.5%. You do, interestingly enough, see a little bit of a bounce back in ASML, but you go to your Bloomberg terminal, take a look at the 2-day charts, 3-day chart on ASML to really get the full picture as to what is happening there. Schneider remains under pressure, which I think is fascinating as well, given that it is in the sort of the power AI story. Nestle bouncing a little bit as well. That safety trade back, Nova rolling over. There's some really interesting stories out there, kind of day 2 stories that are really worth digging into. Let's get the full picture. Let's figure out what is happening here. Joe Easton back with the details.
So one of those day 2 stories, Guy, is Siemens Energy. Now, remember, the company reported orders after the close of trading yesterday and beat on its cash flow and the revenue as well. So we're seeing that stock coming up almost 4% at the moment. But remember, it was down 20% yesterday and the biggest decline in more than a year. So we are only seeing a very small trimming of that massive drop that we saw yesterday. Of course, that was all tied to DeepSeek. So on a 2-day chart, we can see that it's really still down around 17% since yesterday's open. Massive drops for that one, but those orders helping today. The other one with the big numbers in Germany was SAP. Now, they have raised their revenue outlook. A lot of that related to AI as well. So cloud infrastructure seems pretty strong in terms of their numbers there, but perhaps already priced in. That stock's risen around 20% on a 3-month basis, so potentially already factored in some of the strength in their order flow. Then a hat trick of German companies rising. We've got Sartorius. This is over in the medical tech space. It's lab tech equipment, a big beat on their orders coming out of them today, and that one up 15%. They've got a couple of stocks listed there, Sartorius and Stedham also gaining as well at the moment. Those shares rising 15%. That one quite surprising in terms of the jump on those. Then in terms of tariff exposure, remember we had comments from Trump after the market close in Europe yesterday talking about potentially lifting tariffs more than 2.5%. Still all very unclear and what that will be focused on, but there was comments on miners specifically, so we were expecting some weakness, and we are seeing some of those stocks coming down. Glencore, Rio weakening, and the other ones in the focus for tariffs, of course, cars, BMW a little bit weaker, Diageo holding up in the drink space today. Then in terms of rating changes, one of them declining in terms of the luxury space was Swatch. That one goes underweight at Morgan Stanley. We've got results coming out of Swatch next week, and Morgan Stanley says that the sales are likely to be weak, and also potentially they are seeing the impact of the rising Swiss franc on their earnings ahead of that report. So keep an eye on that one. And finally, Anglo American. That one is downgraded over at Bernstein, which says the trade related to BHP is now off the table, given the recent reports we've seen on BHP's interest finally cooling. So they go market perform on that one, and we're seeing Anglo coming down 1% on the London market this morning.
Thanks, Joe. Joe Easton with a briefing on the stocks that are moving this Tuesday morning, 12 minutes past 8. Coming up on the programme, we're keeping an eye on European chip stocks after the US tech sell-off and the threat of tariffs from President Trump. He name-checked a number of sectors, and semiconductors was one of those. We'll be discussing whether this is a turning point for AI. It's been a busy week in tech so far. We'll recap it all. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The news hit the market. I mean, when you look at, today, our results, you see that 50% of the Q4 deals had AI embedded. It's purely consumption driven. So, customers see value, they adopt AI. So I'm actually very confident that today, and not only today, in the years to come, look at our outlook, accelerated total revenue growth for many years to come. We are very confident about our business. And one key driver is, of course, AI.
That's the SAP CEO, Christian Klein, speaking to this program just during the last half hour, in fact. Let's stick with some of these technology themes because there's a lot to bring together today. AI is in focus after the sell-off in the United States, of course, after the apparent DeepSeek breakthrough. We talked about it a lot yesterday, moved markets in the States yesterday, and we're rebounding a little bit from some of that in some places here in Europe today. President Trump, though, has also been making news by announcing overnight a potential tariff on foreign chip imports. Let's bring all of this together. Robert Lee joins us from Bloomberg Intelligence. Lots to talk about DeepSeek and AI, but thinking then, Robert, about the tariff story and what we've heard from President Trump on that front. We often think more about US chip exports, I suppose, given NVIDIA and the scale of it and the importance of it. But here's Trump talking about putting tariffs on chip imports. How big a threat is this?
Well, sorry about that. I had a volume issue a second ago. But obviously, theoretically, it's a threat. But I guess I'm not an economist. Tariffs, and I think the answer is universally understood. It's the consumer. And also, for a policy of tariffs to work, there has to be a locally available substitute. So if you're importing a key component or a chip from China and you can't source an alternative locally, then really, your importing companies and ultimately your consumers will be paying the cost of that. So I think it's a policy that needs to be very carefully considered, given the US semiconductor industry is largely focused on design these days and not manufacture. So much of what the US consumers and US enterprise uses is actually physically made in Asia, of which China is a major manufacturing base, as we know.
But so's Taiwan. Do we think that Taiwan will be affected by this? Because obviously TSMC makes huge numbers of chips outside the United States in Taiwan.
Well, both of you are sat in London at the moment. Isn't the UK government worried about, Trump putting tariffs on its supposed closest ally? Trump's talking about tariffs on the Canadians as well. If he's going that far in his tariff policy, then tariff on Taiwanese imports is potentially a possibility. But again, if you're going to do that, where's the local supply of domestic chips? Outside Intel, Micron, and a few others, there is not a huge volume of US or chips fabricated in the US these days. That's the reality of the situation. There's no substitution.
Well, Robert, to that point, NVIDIA, as Jensen Huang very specifically, and we know that the stock, for example, has been hit by the export controls that you point out, very specifically said that this is a function of kind of some of the export control policy out of the United States. Put some numbers on it for us, though. We know that NVIDIA spent a lot of money making one chip for the States, another chip for everyone else to kind of avoid some of those government regulations that you're referencing. But how much does that cost? And can someone who's not sitting on trillions of dollars of cash use the same strategy?
That's a very good question, and I guess some of this is not fully disclosed by NVIDIA, and also it's a highly sensitive subject. But I guess one common theme in semiconductor world is design reuse. So obviously NVIDIA may design one chip, and so they won't start from a blank piece of paper when they're if they're selling an effectively cut down version. So I guess the incremental cost to the likes of NVIDIA, there would be a cost, but it's unlikely to be overly significant. And as you've said, their free cash flow is tremendous, and as is their balance sheet at the moment. But it's the potential disruption that it would cause, and still China is a significant market for them. So if as a result of these export controls or whatever, access to China market and Chinese customers is going to cut off, that could cause certainly some problems even to the likes of NVIDIA.
Robert, we've heard a lot of views on DeepSeek over the last 24 hours. Some people really impressed by the technology, and some of those who are impressed by it are the ones who perhaps stand to lose the most. Over in the United States, the likes of OpenAI and NVIDIA, at least publicly, are putting out very positive statements. What do you make of the way this is going down in the US tech sector?
Okay, I think as I probably said yesterday, actually, DeepSeek hasn't really been under the radar, and in fact, its details have been listed on US benchmarking websites for best part of 6 or 7 months or so. And I'm absolutely sure that OpenAI, NVIDIA and the like have been aware of its presence for a considerable period of time. And also, theoretically, they would have factored the potential impact, whether that's a positive or a negative, of DeepSeek into their guidance and everything else. So whilst financial markets have reacted somewhat violently, maybe that's just a valuation correction. I think that it remains to be seen what the long-term impact or medium-term impact is on fundamentals. A lot of these companies are reporting near-term, but I think on balance, NVIDIA is the only supplier in town. And I would expect in the near term anyway, the CapEx guidance and AI-related guidance for most of these big tech platforms to remain unchanged. One other thing very quickly on DeepSeek is it's an open source company. They've made a lot of the details of their models are actually available to the public. So without wanting to put too positive a spin on it, this could actually help increase the supply and help shift the industry move down to these low-cost models. And ultimately, that could be a positive thing for the direction of travel. If it results in more cost-competitive, lower-cost models, could that help the proliferation of these AI applications within the broader market? Again, there's a question mark there, but that is one positive way things could evolve. Clearly, there are other alternative, less positive scenarios. So I'm not one to sit on the fence, but I think it genuinely is a little bit hard to call at the moment, and we'll have to see how things develop.
Certainly something we're going to be keeping a close eye on, and certainly something that the SAP CEO had also referenced. Robert Lee from Bloomberg Intelligence walking us through that story. We thank you so much. Let's talk a little bit about the other sector that's certainly moving quite a bit outside of technology, and that is the mining space. Commodities very much in focus after copper and aluminum were moved and shaken by Donald Trump planning to put some tariffs on those metals. You're already seeing some of the mining stocks under quite a bit of pressure. Let's bring in Bloomberg's Mark Burton, who leads our European metals and mining coverage right here in London. This feels like a fairly muted reaction. Is that fair?
It is fair, yeah, and I think it's partly down to the fact that for quite a while, traders and investors in the metals markets have been kind of taking Trump at his word when he said that he likes tariffs. He plans to impose tariffs in the metals markets specifically. We know that he likes tariffs on steel and aluminium in particular as a way of reshoring manufacturing activity and jobs. It's been a kind of a common refrain in his kind of path to the White House. There's also, though, a great degree of uncertainty as to the final kind of scale and scope of tariffs in these markets, and so the muted reaction, I think, is kind of partly down to the fact that a fair amount of tariff risk has been priced in already, but also a bit of inertia and uncertainty over how much further we need to go in calculating.
This is about reshoring. The US is going to need the capacity to kind of compensate. If it's not coming in, you've got to build it yourself. You've got to make it yourself. You've got to smelt it yourself. Does the US, how quickly can the US get the capacity to compensate if tariffs are imposed? If the idea is to bring capacity onshore, where is it?
Well, it's been, tariffs obviously have been a kind of a growing tool in kind of US economic policy over the last several years, and there have been kind of efforts to reshore the production base. In copper, for instance, there are investments underway to increase production via scrap. And so the US has a kind of an import reliance on primary copper, but actually produces and exports quite a lot of scrap itself. So that's one area where if you build a secondary refiner to process that scrap internally, you can boost domestic production in fairly short order. Those investments have been kind of made, and that production should come through in a relatively short amount of time. That's another reason I think that there's a degree of kind of anxiety, uncertainty, inertia among the traders who are kind of thinking about the tactical opportunities that this presents. How much more will the US kind of need to import if ahead of tariffs if they're imposed, and what would the kind of final impact on the trade balance be once they are imposed, and we have this kind of this new steady state where perhaps there is a bit more production capacity.
Okay. Mark, great stuff. Thank you very much indeed. Mark Burton. Coming up, we're going to be kind of focusing once more on what is happening in the States. With $1 trillion wiped off the value of US tech stocks yesterday, is now the time to buy. We're going to be discussing that next with Cathy Wood, ARK Invest founder. That conversation is coming. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Morning, folks. 8:30 in London, 30 minutes into the equity market session. A bounce back of sorts, as you can see on the screen in front of you. It's not exactly a convincing full throttle rally that we're seeing emerge on the screens in front of us. This obviously comes in the context of what we saw yesterday, massive sell-off with US tech stocks. The apparent AI breakthrough by DeepSeek seeing almost $1 trillion wiped off the Nasdaq's 4 biggest companies. NVIDIA alone yesterday saw $593 billion wiped off its market cap. That's the biggest fall for a single stock in US market history, though if you take a look at the top 10, NVIDIA does account for a fair proportion of them, so that's probably just worth bearing in mind. We've got the perfect person to talk about all of this and what the implications are of yesterday's price action, of the DeepSeek news. Kathy Wood is joining us around the table, founder and CIO of ARK Invest. Good morning.
Good morning.
Very nice to see you in London.
Likewise, thank you.
What did you think of yesterday?
Well, as I've been saying, wow.
Yes.
But I think what it's telling us is the cost of innovation is collapsing, which it has been doing. I mean, the cost of AI training is dropping before this, 75% per year. The cost for inference, 85 to 90%. I think it throws the weight more towards inference chips from training chips, and so NVIDIA is highly exalted, and deservedly so, in the training chip space. Inference is a lot more competitive.
Okay, do we fully understand the implications of that? Because the question that everybody's asking this morning is, do I buy the dip? So if we're seeing the landscape changing, is it too early to make that transition and understand what the implications of it are?
Yes, we've been studying the tech stack and where we think it's going. We're going to put out big ideas in, I think, a week.
Give us some hints.
Yes, so here's a hint. We do think there are share shifts taking place within the tech stack. We think platform as a service, so think Palantir, is going to gain significant share. And this news yesterday, I think, highlights that, reinforces that. We think infrastructure as a service is going to stabilize the share. Software as a service will come down a share. However, I've said all of that. All of them will be growing rapidly. It's just how rapid.
Okay. And Palantir, we should say, is one of your holdings, of course, a company you know very well, Kathy. So if inference is going to become cheaper, is this going to be a situation that drives more demand? We were talking about, is that where the positivity comes from? For the companies that don't train but do infer,
yes.
How positive is this going to be?
It's going to be extremely positive. So those using AI, whether for productivity or other applications, are going to benefit. We think the two most profound use cases right now, besides increasing productivity for everyone, autonomous mobility, so think cars, drones, and so forth, and interestingly, the healthcare space. We think the convergence of various sequencing technologies, AI, and CRISPR gene editing that convergence is going to cure more and more diseases over time.
So these sound like huge positives for the businesses that are involved in that stream. What does it tell us about US tech overall? We had a conversation yesterday about whether this is some kind of end of US exceptionalism, and that might be in terms of stocks broadly, but in terms of the US tech sector, are we talking about that? Or is this just, the Sputnik moment that's been mentioned many times, a chance for the US now to catch up again?
Yes, I think competition is great for the U.S., and DeepSeek is competition, no doubt about it. I'm hearing all of the titans, tech titans, speak of it glowingly. I don't think we know everything about it yet. So, no, I think competition is good for the United States. Lowering costs is great for the world. The collapse in the cost of innovation should help all regions of the world. I will say that new productive forces, which was Xi Jinping's new phrase, I think 18 months ago, seems to be showing through right now. Common prosperity was the previous one, and I still think that's in effect. That was more about margins. This is about innovation. So we're looking more closely at China now.
I want to pick up on China in just a moment, but I want to go back to that point you made about cost of innovation collapsing specifically. That would almost lead to the fact that perhaps it brings down the barriers of entry for mid-cap tech firms or maybe people away from the hyperscalers. But you haven't seen that second level outside of the AI adopters really catch the same bid in the way you see Amazon or Microsoft or even Oracle catch up a little bit. What's the hiccup there if, as you say, the cost of innovation is collapsing? Why aren't some of these stocks reflecting that?
Well, I think there's a big debate going on. And if you look at the second, third, and fourth quarter of last year, you look at the mega caps and the rest of the stocks in the S&P 500, you'll see mega caps in the second and the fourth did very well. And the smaller cap stocks did very well, much better than the mega caps in the third quarter. I think there's a little bit of a tug of war evolving here. And if we're right, the most massive concentration in the market in history, worse than the Depression, is probably going to give way to a broader-based bull market. We're seeing that in our portfolios, and it really did start right around, actually, the day after the election. And I think one of the most important things is going to happen is regulations coming down. Even in AI, in the United States, their regulations started to intrude in a technology that is today where the internet was in the early 90s. We don't even know what we have yet. We're as excited as back then, but now is not the time to regulate it heavily.
Well, I think you've got the president on your side when it comes to that in the States. I want to come back to kind of this idea of the hyperscalers here. You're famous for your beta strategy, especially when it comes to the tech space. I think it's fair to say that the highest beta right now is in some of these tech names, in NVIDIA, in Microsoft, in Google, just looking at some of the moves we've seen in the last 24 hours, not to mention the last 12 months or so. Why not increase your holdings for more exposure to the hyperscalers?
Yeah, we do think, we do own Meta and Amazon in our flagship, and we own more of them in our other more specialized portfolios. And in Europe here, we have an AI and robotics fund, and we hold probably most of them because they are going to benefit from the declining cost in AI. And even Meta, who was really the open source leader. DeepSeek is open source. I think Meta is saying, wait a minute, what's going on here? And they're going to use some of the techniques, the algorithms that DeepSeek has used to improve their own platforms. So we're not negative on them. We think that the neglect of the rest of the market has been extreme, and that is going to change. That the strongest bull market out there is a broad-based one. A market favoring 6 or 7 stocks alone is not a strong bull market. And so if we're right, the bull market will strengthen out and gain momentum, rewarding smaller cap stocks than we have seen thus far.
You use Meta as a great example. Meta, before they went all in on AI, went all in on the metaverse, and there was a big pullback on some of that investment. Yes. Do you need to be sitting on billions or trillions of dollars in cash to excel in AI in the next 5 years?
Well, I think DeepSeek just taught us that the answer is less than people thought. You don't need as much cash as we once thought. I don't know if the number is right, 6 million to train that model. That's unbelievable. It's a tenth or less. Now, many people don't believe that, but again, it fits in with the costs collapsing thesis. They were collapsing anyway. DeepSeek has just stepped it up a notch.
Kathy, you mentioned earlier that you're increasingly looking at China. I'm interested in what that looks like, but also how much you think that the US tech companies are going to engage with this, or US businesses will engage with this new technology, DeepSeek, coming as it does out of China, given everything we've heard about TikTok and where your data ends up. That might raise some flags for some people.
You know, it's very interesting. We've been thinking about President Trump, or many people have been thinking that, oh, wow, this is very negative for China and U.S. Relationship with China. But there is another point in history that might be repeating to some extent here. It's called Nixon in China. Nixon did not trust China. He and everybody trusted Nixon because he did not trust China, and they knew he wouldn't lead us astray. I think the same thing is happening here with President Trump. And from a technology point of view, I think he likes the competition, and he actually did say, I believe yesterday, that, you know, this just shows that even in the U.S., regulations, especially that executive order on AI, which he rescinded, probably has held us back. And now, let's go.
Kathy, you talked a moment ago about the Great Depression and the concentration we saw going into the Great Depression and the number of single stocks. Do you think we get a smooth transition from that concentration to the broadening out of the market? That's not what the Great Depression taught us. It taught us that you get a collapse, and US consumer confidence and so many other things seem to be hinged on this stock market performance. Is it a smooth ride from concentration to diversification? How big a gap could there potentially be between one and the other?
Yes, if you look back at the Depression, I'm not going to get all of these numbers right. What you'll see is the massive concentration took place until 1932. Yeah. At which point the market started broadening out. And small or mid-cap stocks back then way outperformed large-cap stocks. And it makes sense. They had been absolutely destroyed during the Depression, which was binary. Is this company going to survive or not? With output down 30%, GDP down 30%. It is surprising to me that we got to an even greater point of concentration than the Great Depression. It tells you that in an underlying sense, there was a lot of fear in the market, and that investors were piling into cash-rich companies that, oh, by the way, had, a leg up perhaps in this new thing called AI. Now I think it's just going to broaden out.
Okay.
Kathy, stick with us. We have plenty more to ask you, especially on that deregulation theme, and of course what this means for those risk assets. We're going to talk about volatility next, specifically in cryptocurrencies in the wake of the tech sell-off. Kathy isn't going anywhere. Don't worry about that. Yeah.
We will continue that conversation. Brief interlude to mention the banking sector, though. We have some news lines coming through from HSBC. They're saying they're going to be shuttering some of their investment banking units in Europe and the US. They will retain more focused M&A and equity capital markets capabilities in Asia and the Middle East, and will look to wind down those activities in Europe, the UK, and the Americas. So a lot more to unpack when it comes to what that means for the broader HSBC business, for sure. We'll be back to Kathy shortly. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome back to the opening trade. We're about 45 minutes into today's session. Seeing green on the screen marginally, but green on the screen nonetheless. You are seeing the stock 600 higher by 0.3%. The other index is right on its heels. Underperformance over in France, though. Some of that is a luxury story that, of course, we're going to continue to keep our eye on. But I want to bring back in Kathy Wood, of course, this founder, CEO, and CIO of ARK Invest, especially in the context of the tech sell-off yesterday, because at the same time, we also saw Bitcoin seeing quite a bit of volatility. We're looking at a Bitcoin handle of about 103,000. Kathy, I want to bring you into this conversation. You've been a crypto bull for a very long time.
Yes.
You've also, prior to the break, talked a lot about deregulation under Donald Trump in the tech sector, but then also in the crypto sector as well. What has fundamentally changed since he's taken office when it comes to deregulation?
I think we will get significant clarity in terms of regulation. We will get legislation as well. I think many more policymakers in Washington understand that this was a single vote issue for many voters, especially young voters. And so this is becoming much more of a bipartisan issue. And of course, you have the executive branch also supporting it mightily, proposing that we include Bitcoin in Treasury reserve. So you've got, I think we're going to have support of all 3 branches of government are going to be supportive, which is a big change.
Well, it would be a big change. And I mean, are we really sure of that, I suppose, is the question, because Gary Gensler, the SEC, had a very different view of the risks and the retail investor protections that should be in place when it comes to crypto. There are surely a lot of people who still believe that's important.
Well, I think he didn't understand that this is the next big wave of the internet. This is the layer of the internet that developers did not build in the early 90s because no one thought anyone would buy or use financial services on the internet. I remember back then, no one was going to give their credit card to the internet, right? This is the next big wave, and it's a huge efficiency move for the financial services sector. So in terms of Bitcoin specifically, it is really the leader in a new asset class. And we have a paper out on that. You can see the low correlations, which do define a new asset class. And it is a global monetary system. It's a very big idea. My professor, mentor, friend, Art Laffer, when he collaborated with us on our Bitcoin paper in 2015, he said, this is what I've been waiting for since the U.S. closed the gold window in 1971. So he has been energized by this new movement towards a rules-based global monetary system.
Do you think Trump's going to be on board with that? Like the president has indicated he's quite a big fan of the US dollar, and it sounds like what you're suggesting is a replacement for the US dollar.
No, we actually think that that these two will coexist, and if anything, what we're seeing with the stablecoin movement, which is how people is the on-ramp into decentralized financial services. They're all backed by Treasury securities, which de facto they're backed by the dollar. So we think that movement is gaining momentum here, especially now with the deregulation.
You say they're rules-based, but then we see more coins coming all the time. So they might be restricted
from
supply.
The president.
Yeah, from the president and his wife. So
I said Bitcoin was rules-based. 21 million units. And we're nearly at 20 million now. So that scarcity value will continue to support Bitcoin going forward.
So you're talking about the stable coin kind of being backed by these, basically by the federal government. Why not just use the digital dollar and develop the digital dollar as that same, with that same appeal?
So I live in Florida, and the governor of Florida, Governor DeSantis, has said he will never allow a central bank digital currency to be used in Florida. I think Texas has said the same thing. This is a states' rights issue, and it's all about privacy. Many people here in Europe don't think we care about privacy. On this one, on this score, we care about privacy. And this president very much supports that point of view.
Well, you're talking then, wading back into the idea of regulation and cryptocurrency. A viewer is also kind of chiming into this conversation. Cryptocurrency has rallied so much on that speculative ability and being unregulated. But if you're talking about these almost caveats to stable coins or caveats to Bitcoin or caveats to other tokens that may be traded, doesn't that kind of eliminate the fundamental appeal of what has moved it to 103,000?
So Bitcoin, I don't agree with that at all. I thought where you were going was all of these tokens being issued. We went through another period like this. It was 2017, and Bitcoin that year went from less than $1,000 to $20,000. That was the ICO boom, and most of those failed. So it's buyer beware. Yep. Be careful, and that is why we need some regulation here, because it's out of control, as I think you would say. Bitcoin's a completely different animal, though. Completely different.
Isn't Bitcoin just a correlated asset to tech? That's the lesson from yesterday.
No, it isn't. Actually, it's part of the tech movement. The
correlation on the numbers looks pretty convincing.
It's part of the tech movement. But if you look at Bitcoin, it has served as both a risk-on asset, so that's tech, yes, but also a risk-off asset. When we went through the regional bank crisis in the U.S. in the spring of 23, Bitcoin took off. Why? Because there's no counterparty risk in Bitcoin.
If big tech sells off, will crypto go down significantly?
The correlations are there is a correlation, but it is not as high as, small cap equities to large cap equities. The more institutions get involved, the more correlations will go up. But right now, if you look at the statistics, the correlations in terms of returns and risk among these assets, very different.
We'll let you get back to Florida and the better weather and sunshine. It's great to see you, though, in London.
Thank you, guys.
Thank you very much indeed for stopping by to see us. Kathy Wood. Great stuff. Thank you. The CEO and CIO of ARK Invest.
Now, if there's going to be a lot more talk of crypto, and we've certainly got that impression from the president, then is there going to be a lot more of that crypto money chasing luxury goods? Let's make the link to LVMH, shall we? Expected to report a subdued set of earnings later today, waiting for a crypto boom, perhaps. Let's talk to Bloomberg opinion columnist who covers luxury and consumer goods, Andrea Felstead, who is with us on set this morning. Andrea, so LVMH heading towards the earnings. We're thinking of crypto, but tell us the big picture story around LVMH. What are we looking for?
Well, we're looking to see if it's going to outperform in the same way that Richemont and even Burberry did. So far, all the luxury goods companies that have reported so far, Richemont, which owns Cartier, even Burberry, that's been really struggling, they've really beaten expectations with Richemont by some mile. So, my guess is LVMH will do the same.
In terms of What is driving it? Is it America? Is there any turnaround that we're going to see anywhere else in the world? What are these numbers going to tell us about where LVMH goes next? Not really about where it's been, but where it goes next.
I think it's all about the US. China isn't getting any worse, but it's not getting any better.
Right.
Whereas the US, since the election, since, Kathy just talked about Bitcoin, since, the stock markets have been sort of melting up until recently, US luxury is very correlated with those factors. And that seems to have driven demand in the US, whereas China, it's not really coming back yet.
Can we talk about the news of the last 24 hours when it comes to LVMH? That is the minority stake of Stella McCartney getting bought back. Walk us through that story.
It's really a tidying up by LVMH. We saw them sell Off-White. They're now selling their stake in Stella McCartney. This is really tidying up the portfolio. We've had big changes at LVMH, lots of management changes. Questions about succession. It's really just a tidying of the portfolio. The big issue would be is if there is any type of breakup of LVMH. We actually wrote a year ago that, you could break it up if you were to value Louis Vuitton and Dior anywhere near Hermes. So LVMH is on about 25 times PE ratio. Hermes is on 55 times. So if you were to take like Louis Vuitton and Dior and value them anywhere near Hermes, at the time we worked out that you basically got the rest of LVMH for free.
Yeah.
Numbers might not be quite the same now given what's happened in the last year. Lots of speculation they could spin off wines and spirits. So what everyone is looking for is for LVMH to become much more of a pure luxury play. You've got you've got wines and spirits, you've got the duty-free business, you've got beauty. Beauty's pretty good at the moment, pretty good hedge. But you've got all these things. Does it become more of a pure luxury?
He spent years building it up. Maybe the value's in tearing it down as well. Two-way trade. Andrea, we'll look forward to the numbers a little bit later on. They're coming just after the market closes a little bit later on. Blooming opinions. Andrea Felsted. Let's get back to this HSBC story.
And there's a link there, isn't there? Because there's a lot of M&A in what you just described and a lot of fees for some bankers. Really big story out of HSBC. We were talking to Cathy Wood when it broke, but this really interesting story. HSBC is winding down some of its investment banking operations in Europe, the UK and in the Americas, really retreating on the investment banking side into its core operations in Asia and the Middle East over coming months. So this is Europe's largest banking group, essentially withdrawing from providing equity capital markets and advisory services outside Asia and the Middle East.
So there's a big building just over there that's being kind of refurbished at the moment. It's where HSBC is ultimately going to go, out of Canary Wharf. And there's been this sort of chatter for ages. People I know, there aren't enough seats and desks in that space. Maybe we now have an answer to the question of the desk space problem at HSBC.
Yeah, an interesting one. The shares are down about, I think, 0.8% here. So certainly a story that's moved the markets. But we know, to your point, that there has been quite a bit of restructuring. I think the big question for the markets here is, do you still buy the dip? And you are seeing some marginal positivity in these broader indices, especially when you look at Europe. Outperformance in Germany coming off of those SAP results. Underperformance over in France. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
European equities take a breather after a deep sell-off on Wall Street and Nvidia's $589 billion rout, the largest in stock market history. Well, DeepSeek's competitors respond to the Chinese AI disruptor. Nvidia calls its new model excellent, while Sam Altman welcomes the competition and promises more from OpenAI. Plus, President Trump wants across-the-board tariffs that are much bigger than 2.5% and plans to target foreign chips, pharmaceuticals, and metals. So first thing is first, let's take a look at the European markets map. Again, there's quite a lot going on. We're not only looking at the fallout from semiconductors after what we heard at the weekend from DeepSeek, but we're also trying to figure out what kind of tariffs, whether they're targeted or not, what that means for markets globally. For the moment, European markets pretty much unchanged. Look, the FTSE's gains in 0.4%. More interesting to go cross-asset. Again, a couple of the other things we need to watch out for is dollar actually advancing after U.S. President Donald Trump's latest tariff threats. Now, for the moment, it does feel like the market is really taking it as a threat. That could change. U.S. 10-year yield for 5.627. And pre-market, a couple of the other things that we've been watching out for. I think we probably have NVIDIA and some of the semiconductors that we're looking at. You can see NVIDIA yesterday was slammed. Today, pre-market, gaining 4.5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone. This is The Pulse. Now, President Donald Trump has weighed in on DeepSeek's breakthrough at a Republican Party retreat in Florida. Now, he welcomed its arrival, but also delivered a warning.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
Well, let's bring in Bloomberg's EMEA News Director, Roz Matheson. Roz, we'll get on to, of course, some of the DeepSeek news that really roiled markets in just a second. But Donald Trump was also quite clear on wanting to introduce tariffs on certain industries. I'm not sure who they're levied to or whether he'll actually come through with it.
Well, that's right. This is all this sort of noise around, will he introduce tariffs? When will he introduce tariffs? How much will they be? And how quickly will they move? And obviously, we reported earlier this month that there were a number in Donald Trump's inner circle, including Scott Bessent, who's the incoming Treasury Secretary, advocating for a gradual approach, like maybe starting with a number between 2% and 5% and then going up on a monthly basis. So you want to see whether, countries respond to that initial tariff, that blanket tariff, and then how can they negotiate negotiate from there. And so further signs again overnight that might be what Scott Bessent wants. But clearly the message each time from Donald Trump on the back of that is, hang on, I'm looking at some pretty serious tariffs here. And he really wants to keep that option open. I mean, even if they end up with gradual tariffs or no tariffs at all, he wants that as a tool of leverage right now. He wants that hanging over people. You can see that's why the market is kind of whipsawing around quite a bit. But it's clear he wants that in the toolbox. And we saw from the example on the weekend of Colombia that he's very, very willing to use it if need be.
But Roz, so I know it's difficult to find a Trump whisperer to really understand how far he's ready to go, but he's basically saying to the pharmaceutical companies, look, he wants to compel them to bring manufacturing in the U.S. So if a company says, I'm going to add, 5,000 jobs to the U.S., is that enough? Do we know what the threshold is, or is it just impossible to tell?
Well, certainly you want to show that you're doing something, be it building factories, bringing jobs back. And if you can make that number as big as possible and make it sound really good, the better. I mean, we saw Saudi Arabia recently pledging to spend a lot of money in the US. How much of that is real or feasible? Perhaps it doesn't matter because it's a really big round number with a lot of zeros after it. And that's what really counts in the end. So if you're a company, what you do want to show is either talk up your existing manufacturing there, show what you're already doing, and then add on to that. I mean, you can promise factories that could be built in the next 5-10 years and don't have to necessarily eventuate if you're really wanting to try and manage Donald Trump on it. But it's about just showing him that you are listening to him is the key.
Roz, I keep on hearing that, the last 10 days were frankly a whirlwind in terms of executive orders, in terms of policies. I mean, will this administration have to slow down? Does he have the team around him now put in place? Like, how do you see it going in the next 2 months?
Well, obviously he wanted to demonstrate a lot out of the gate, and he was doing that even with some of the things he was announcing and saying overnight. So he's obviously trying to move what he sees as democratic officials out of the, the machinery of government, out of the bureaucracy, out of different ministries. He's got work to go there. He wants to demonstrate very much on the immigration side, so he's pushing on migration, but, he's trying to do a lot in quick succession. At some point you do need to see, do these things, have they had an effect? And then go on. But obviously he is trying to demonstrate he's as good as his word on a bunch of things.
Roz, thank you so much. Roz Matheson there, our EMEA News Director. We also had a conversation with Keir Starmer, the Prime Minister of the UK, on tariffs, on trade, and how dealing with Trump, or what that will look like in the next 5 to 6 months. We'll bring you that interview very shortly. In the meantime, NVIDIA has called DeepSeek an excellent AI advancement. OpenAI Sam Altman has praised its model, and President Trump says it's a wake-up call for the U.S. Now, the Chinese startup has upended global markets with NVIDIA's drop, the largest ever one-day loss in market history. Now, the release of R1 has sent shockwaves through the U.S. tech industry, leading to re-evaluation of the economics of the AI investment boom. So let's get more with Robert Lee from Bloomberg Intelligence. Robert, I mean, there's so much copy in saying, well, actually, they do have some of the NVIDIA chips that they're not supposed to have, or maybe they do or they don't. I mean, is this just a turning point for the AI sector? And what do we actually know?
Okay, good question. We don't really know on how much inventory they've got access to. We don't really know if these claims on cost down, the sort of approximate $6 million, are correct. I mean, on one hand, it seems almost too good to be true. But what we do know is the performance of their models is amongst the best in the industry. On some external benchmarking services, in fact, benchmarking websites run out of the US, DeepSeek's models have ranked number 2 globally. So the evidence is there that they have a highly effective and efficient model. I do think there is truth in the cost down claims, and also they've been extremely aggressive on the pricing that they're charging their customers. So I think ultimately the story does hold together. Some of the details perhaps not so. And coming back to your question, this is a turning point in the industry. Who am I to argue with President Trump? I think it is a wake-up call. Whilst people in Asia had been familiar with DeepSeek for some time, clearly that isn't the case in terms of financial markets, given the reaction we've seen. And I think, as they always say, there's no room for complacency. So this is a wake-up for the big tech platforms, and we'll have to see how they evolve their model and their business plans on that front. Maybe they move to smaller, lower-cost models going forward. I think that's probably the direction of travel for the industry from here.
So, Robert, is this the biggest challenge it's faced? And actually, are there any security, national security concerns? Again, I think, there's a clause in saying that the Chinese government has access to all the kind of modeling that Chinese AI uses.
Yeah, there's always a national security concerns on both sides. You'd be concerned if a potential rival has access to sensitive consumer data. But I think the big question mark and the big challenge for the industry remains the same: monetization. Looking at the US tech platforms, they're spending tens of billions on CapEx per quarter. I still think that fear of missing out is driving a lot of the decision-making on the CapEx front. I mean, we saw what Meta had to say at the end of last week. And whilst companies are beginning to monetize, I'm still of the view that they're not monetizing anywhere fast enough, and the absolute level of monetization remains very low. If you did a straw poll of people in your studio now, or even amongst the viewers watching this, I do wonder how many people are putting their hands in their pockets and actually subscribing to these AI services at the moment. I'm sure we've all played around with them, had a little bit of amusement, this, that, and the other. I'm not saying that they don't have a real use, but the majority of consumers at the moment don't see that there's sufficient value add for these products, and that is a major barrier to monetization, particularly when you're a big platform shelling out tens of billions a quarter. So I think there is a potential day of reckoning coming at some point later the year, where the more marginal players in the industry physically won't be able to continue to afford such high levels of CapEx. I think the large tech platforms should remain okay, because obviously they benefit from very strong internal free cash flow, and most of them are sitting on an extremely strong balance sheet. But equally, that just prolongs this cycle. There's an awful lot to say on this, but hopefully that answers some of your question.
Rob, so interesting. Thank you so much. It was interesting, actually. I thought in Davos, a lot of the bankers used it a little bit more for personal reasons than, people, for example, in the newsroom. Rob Lee from Bloomberg Intelligence answering some, very important questions as we're trying to figure out what happened over the last 3 to 4 days in the markets. Coming up, we'll continue discussing the market fallout from DeepSeek's emergence and much more with Tushka Maharaj, global strategist at multi-asset solutions at JP Morgan Asset Management. Plus, a little bit later in the show, our interview with the UK Prime Minister Keir Starmer as he lobbies chief executives at some of Britain's largest companies here at Bloomberg's European headquarters in London. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Now, the dollar strengthened after U.S. President Donald Trump said he wanted much bigger universal tariffs. Let's get more on the latest market moves with Tushka Maharaj, global strategist and multi-asset solutions at JP Morgan Asset Management. Tushka, thank you for joining us. I mean, there's quite a lot of market turmoil, whether it be the tariffs, whether it be the latest we know with DeepSeek. Is this going to be volatility for 2025?
Good morning. Yes, thanks, Francine, for having me on. Yes, we agree there is volatility in these markets, and especially, as you say, with the new administration in the U.S. We've seen in the last few days quite a lot of news flow on tariffs, and we think that that will keep uncertainty high. But it's not a reason to prevent us taking risk. And I think yesterday was a good example of the market having had a shock in terms of tech, the tech sector and tech innovation, which I think is a welcome development. But what was interesting was that 70% of the S&P still ended up in positive territory, and the equal weighted index ended up positive. So I'd say that theme of broadening out of growth, that theme of broadening out of earnings, is something we're watching this week and into earnings season. But I'd say that was reinforced post, even in the volatility.
Yeah, and Tushka, I mean, we've been talking about some of the, Magnificent Seven being priced to perfection. Is this just case in point?
Well, I do agree with the point that valuations and that concentration of the S&P has been a focal point. I do see yesterday, or at least even though we don't have full information, I'd say yesterday was an example of the market using a catalyst and then high valuations as an accelerant for what happened, and positioning, as you say, was already quite long in the tech sector. I wouldn't necessarily say that this is a start of a more prolonged sell-off. We need more information to form a bigger view. But what I would say is that disruption and innovation in the sector is something we should be more comfortable with. And to your point about higher volatility, higher risk premia in equity markets, I think that is something we're going to have to deal with. But ultimately, when we think about this from a big picture perspective, we see this innovation as helping bring down the costs of training, the cost of usage, and this will help broaden the availability of AI to other users of the technology. So when you think about that, Jeevan's paradox, more usage, more demand for AI, might actually support the tech sector more, given this innovation.
Tushka, what are you expecting for earnings season? Does it give us, is it, I guess more anxiousness as we look ahead to possible U.S. policies, or you expect to have a robust quarter?
Yeah, so this week where we have over 30% of the S&P reporting, I think it is going to be quite informative. It's taken on a new connotation in the last 24 hours, watching spending, CapEx spending, especially by the big tech sector. But I would say that we have confidence in strong earnings delivery across the board. But what we're watching most closely is the broadening out theme. So last year, the idea that the Mag 7 delivered 40% of earnings. This year, that's likely to come down to about half of that. Whereas the rest of the S&P, we're likely to see more than a triple-fold increase in their earnings expectations, going from 3% last year to expectations closer to 13% this year. And I'd say it's that second component we're watching very closely, both in terms of margin growth, but also that broadening out of earnings and confirmation that the rest of the S&P can outperform consensus expectations, I think would be a very strong positive for equity markets at this point. But as you say, we are watching what happens with the response of the large tech stocks to the news flow in the last 24 hours, and their intentions on CapEx, I think, will be a hyper focus for the market in this week's data.
Tushka, when you look at euro area growth, is it slowly bottoming out? I know there's been so much, I guess, discouraging news from Europe. At what point does it bounce back, and what does that mean for equities?
Yeah, we've been watching this quite closely. I'd say it started in the early part of December, where the PMIs in the euro area were starting to show some signs of improvement. And now we can't lose sight of the fact that they're improving from a very low base. And so yes, we've used Europe in the past as a funding market, but we're quite conscious that that's consensus, that the market's pricing in that negativity. And I'd say in the first few trading sessions of this year, we've seen strong performance of the European equity market. Part of that a reflection of the valuations relative to the US, the cheaper valuations relative to the US, but part of that bottoming out of the PMIs, and the recent data have been more encouraging. What we're watching to build momentum in this view is more the outlook on the political front. You mentioned tariffs being an uncertainty, and I think that will hang over confidence and business sentiment even in the euro area. But more importantly, we're watching the German elections in the middle of February, where the likelihood of seeing more fiscal spending, more domestic fiscal spending that's targeted either at investment and infrastructure or helping with welfare costs as well. So that that I wouldn't call that necessarily a game changer, but could that be another catalyst for more optimism in the euro area? I'd say yes. That's something we're looking for.
I mean, what would be a game changer, I guess, is a softening from the Trump administration on China. Again, I don't know if that happens. There's been, a couple of sounds maybe on that in a TV interview that could quickly be reversed. But what are you expecting from China and some of the Trump policies?
Yeah, well, what could be a game changer? So I think, yes, one of those avenues could be the softening of tariffs, the usage of it more as a negotiating tactic rather than something more punitive. But I would say for the euro area, what's more game-changing would be the idea of a relaxation of the debt brake in Germany, where you could see more spending either through the Conservative or the Social Democrats, a coalition creating more spending in Germany. What could be a broader game changer for risk markets? It would be a Chinese policy response that's larger than consensus today, alongside a softening from the Trump administration. But I would say that, broadly speaking, the news flow over the last 24 hours has given us more confidence in this idea that innovation and disruption in the tech sector will ultimately lead to a lower cost base, which will bring in more users of that technology. And ironically, we see that as being quite supportive for growth over the medium term, and not just in the US. I think that's the crucial difference.
Thirshka, thanks so much, as always, for joining us. Thirshka Maharaj there, Global Strategist of Multi-Asset Solutions at JP Morgan Asset Management. Now, coming up, we'll hear from Black Swan author Nassim Taleb on the recent rout in U.S. tech stocks following the emergence of DeepSeek. Plus,
well, the number one priority of this Labour government is growth. And by that I mean wealth creation. And that's why what you've seen in recent days is a number of announcements about how we're going to strip away regulation, strip away the inhibition of planning, use AI to take us forward. And so today we've had the opportunity across a number of sectors to have a really good discussion about how much further we can go. But the number one mission is wealth creation. We have to get our economy working. I think we're beginning to see how that's turning around, and we'll build on that as we go forward.
Our interview with the UK Prime Minister Keir Starmer as he lobbies chief executives of some of Britain's largest companies here at Bloomberg's HQ in London. This is Bloomberg.
multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It shows the fragility of the wealth formation based on a very small number of stocks causing it. Okay, how much of wealth formation came from NVIDIA? 3 trillion capitalization. A lot of it is recent. Okay, so it shows us how much the whole economic structure is fragile because of that.
That was Nassim Taleb, the senior scientific advisor at Universa Investments and the author of Black Swan, speaking about the steep sell-off in NVIDIA stock and the market's fragility. Now, also making news, President Donald Trump says Microsoft is in talks to buy the U.S. arm of TikTok. Now, other bidders so far include AI startup Perplexity and billionaire Frank McCourt. Microsoft and Oracle were in the running to buy the app in 2020 when Trump first pressured Chinese owner ByteDance to sell or face a ban. Coming up, our interview with the UK Prime Minister, Keir Starmer, as he lobbies chief executives at some of Britain's largest companies here at Bloomberg's European headquarters in London. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging.
go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The Prime Minister, Keir Starmer, tells Bloomberg the UK economy is starting to turn around, and he'll meet President Trump soon. Our interview coming up. NVIDIA claws back some ground after its $589 billion round, the largest in stock market history. Plus, DeepSeek's competitors respond to the Chinese AI disruptor. NVIDIA calls its new model excellent, while Sam Altman welcomes the competition and promises more from OpenAI. So the UK plans to unlock billions of pounds to help drive economic growth by allowing companies to invest surpluses from pension funds. Now, it comes with the Labour government under pressure to boost sentiment after its tax-raising budget last year. Well, speaking this morning with us here at European headquarters in London, the Prime Minister, Keir Starmer, and the Chancellor, Rachel Reeves, have been lobbying chief executives at some of Britain's biggest companies for support. Well, the Prime Minister spoke to us after the meeting, saying the UK economy is beginning to turn around.
Well, the number one priority of this Labour government is growth, 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 growth. And by that I mean wealth creation. And that's why what you've seen in recent days is a number of announcements about how we're going to strip away regulation, strip away the inhibition of planning, use AI to take us forward. And so today we've had the opportunity across a number of sectors to have a really good discussion about how much further we can go. But the number one mission is wealth creation. We have to get our economy working. I think we're beginning to see how that's turning around, and we'll build on that as we go forward.
Prime Minister, how do you look at, of course, tariffs? You had a very productive call with President Trump. He's going after the EU in terms of tariffs. Do you worry that he'll go after the UK next, and how do you straddle that?
Well, I had a very constructive call with President Trump over the weekend, very positive. And of course, there's a long history between our two countries. It's a special relationship. We've fought together in wars. We've, worked so hard on security and intelligence together. And there's a huge amount of trade between our two countries. I think that's to our great advantage. I think that's something that we can build on. And so I was very pleased with the engagement that we've had with President Trump. We'll build on that.
Yeah, so do you think tariffs can be kept at bay?
Well, we will work constructively with the US. Look, we've got a huge amount of trade between our two countries already. So the base there for even better trading relations, I think, is already there. We need to build on that. And that's the mindset that I bring to this. It's the mindset that President Trump brings to this.
Prime Minister, on Greenland, do you think it has to stay part of Denmark?
Well, I'm not going to comment on issues that are not central to what I have to deal with in relation to the UK and the US relationship. It's a special relationship. It's been there for a very, very long time, and there's a shared intent between myself and the President to build on that.
The UK Prime Minister Keir Starmer speaking at Bloomberg here, of course, in London a short time ago. Now let's bring in Philip Aldrich, our senior economics reporter on Bloomberg's John Stepek, author of the Money Distilled newsletter. So thank you both for joining us. I mean, look, there was market turmoil. There was a lot of question marks about how the UK was going to achieve growth, whether the budget was a mistake. Are they now trying to recalibrate and get back on message with business?
Well, they have always said that growth was, the priority because they had this 2.5% target by the end of the Parliament, and they want to be the fastest growing major economy in the world, even faster than the US. So the budget seemed to be all about raising the taxes, fixing the fiscal position, and obviously it annoyed a lot of businesses who were hit with this £26 billion tax. So I guess they are trying to bring back, what is the agenda for growth? Because that was the piece missing. It was not a budget for growth. It was a budget for, basically big taxes. Rachel Reeves has got a big speech tomorrow on Wednesday, and they've already unveiled these kind of, effectively they're saying we want to go for deregulation. We want to, just bulldoze through the planning rules, and they are trying to release money through the pensions system to get investment into the UK, because as Starmer says, growth to him means investment.
Yes, growth, everything's better with growth, right? Let's start there. Of course, if you have growth, you're fine with your fiscal plans. And John, Phil wrote this great story on basically it's the pension surplus that gets reinvested. We're talking about a third runway at Heathrow and potential expansion in other infrastructure projects. I don't know where we are on Sheen. Is this enough to get the kind of growth that the UK needs, especially if you're competing with the US?
Absolutely. I think it's a good idea to go for growth. We've definitely been held back by planning issues. Heathrow's been sitting there, the third runway's been around for, decades, and it's been signed off a number of times in the past as well. So the thing that's going to be the real, obviously, test of this is whether they actually get it past the Cabinet. I do feel that one issue is that, the budget came out, and beforehand they sort of talked about growth, but obviously what happened was they actually slapped the private sector in the face with this big tax on employment. And that is not something that you do if you want to encourage growth. You don't make it harder to employ people. And we have seen the effects of that feed through in the data. And I feel that what has happened here partly is that Rachel Reeves in particular has seen how vulnerable the UK is. The bond market turmoil was not her fault, but not having enough space was arguably her fault. So she's kind of left herself between a rock and a hard place. And the only way out now is growth. No, they can't do further tax raises because they've seen what happens when you do that. But they also are going to struggle to push through public sector cuts because, it's going to be very difficult for this government to leave itself open to accusations of austerity after it spent the last 14-odd years complaining about Tory austerity. So I think in a way this is the only way out that they see. And that, to be fair, that's a good thing because we need growth. We desperately need growth.
But I guess, Phil, there were so many questions about whether the Chancellor could stay in her job after the market turmoil. Is this going to be a kind of a new Labour policy? So if they don't have the growth, will they have to go back for the, spring statement and change some of the things that they announced in autumn?
So the growth isn't going to come
straight now
in time, right. Yeah. So actually, at the last count, the economy is smaller than when Labour came to power. And all the sentiment indicators have remain miserable, basically, among both consumers and businesses. So they've got to basically shift the dial. I guess if you get confidence and a big morale booster coming, then that helps. And telling businesses that there is going to be a degree of deregulation, and there have already been specific policies announced actually on planning to make it a lot easier to get building and developments off the ground. And they are announcing projects which have been, there's a whole bunch of stuff that's just sitting on ministers' desks and hasn't been given the green light. And actually, Angela Rayner has been one of the more active members of the cabinet getting stuff through in the housing and building department. But it really, on the actual day of the March 26th when the OBR comes out with its new forecast, it's entirely plausible that Rachel Reeves has got less than zero headroom, and she has to find extra policies, and that is going to be a difficult one for her, as John was saying. It looks like welfare may be something that they tried to go after as a priority.
John, are they still very vulnerable to market turmoil? Again, this was originating in the U.S., but this is a small open economy, huge borrowing. Kind of dependent on the kindness of strangers. The kindness of
strangers, yes, the old catchphrase. Yeah, I don't, people have been very doomy and gloomy about it, and I don't think it's that bad. But the problem is, if interest rates do go up in the UK, then obviously, for a start, it kicks the housing market back. The housing market is a big driver of the wealth effect and how healthy consumers feel in the UK. And also, I think So if you get interest rates kind of heading higher, then it doesn't, well, again, it kind of puts the Chancellor on the spot. I do think one problem is this, the problem is this insistence on following exactly what the OBR does. And again, they've sort of learned some of the wrong lessons from the Liz Truss kind of episode. I feel that the OBR is kind of enshrined too much, and I think that the Chancellor should feel a bit more free to say, actually, we're going to pursue this. We're going to pursue this growth plan. We're going to give it room to breathe. But that's again politically difficult because of the corner they've backed themselves into.
Phil, the hardest question you'll ever get from me is how do you think this government measures success? Like, what do they need to, how do they think we've done a good job here?
Well, so, I mean, I think the guiding principle has been, to fix the public services effectively. And it does come back to growth. Like you're saying, growth cures everything. So if they can get the NHS working, they can get, social care functioning, the local authorities that are all bankrupt practically. If they need to get to the end of this 5 years and show, one, that the economy is working, but two, that the people's living standards have improved. So continued increase in real wages and public services that function. I think that's what's going to happen. That's what they're going to be measured on, above all.
Thank you both for joining us. Phil Aldrich there and John Stepek on the very latest from the UK. Now, coming up, we'll have more on how DeepSeek has sent shockwaves through the tech industry. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Well, Chinese startup DeepSeek has upended global markets as its cost-efficiency AI model is likened to that of OpenAI in terms of capabilities. Now, the release of R1 has sent shockwaves through the U.S. tech industry and posed significant challenges for NVIDIA. Let's get the view now from IPEC. Oscar Descaya, senior analyst at Quizcode. IPEC, thanks so much for joining us. Does this change everything for AI, or do you have many questions on the Chinese model?
Well, actually, it does not change everything for AI. So first of all, I think that everybody should calm down. What we saw yesterday, the market growth was obviously amplified by the high valuations of the US AI stocks, also the existing worries regarding the massive cost of investing in AI and the unsatisfactory return on investment so far, especially last year. But looking at DeepSeek, we have a lot of unanswered questions out there, including whether the DeepSeek's model is integratable, for example, with the other applications. We will see that very soon, reportedly from February. But we don't even know if they really built a model of less than $6 million as they say they did. What we understand is that the DeepSeek company, they use a lot of NVIDIA chips, cheaper NVIDIA chips, but NVIDIA chips still to build their model. So the idea, the simple idea that we could do a performant AI model at cheaper price is obviously waiting on the revenue outlook for many chip companies out there. But I think that it's very early to talk about a threat on the AI dominance and a game-changing model from DeepSeek.
Yeah, and Ipek, I guess, I mean, you say it very clearly, right? It basically brings, you think, an equal performance just at a cheaper price. What are the market implications of this? Are we going to see more demand for some of the cheaper chips? So NVIDIA loses out, others gain.
Well, first of all, the idea that we would see a growing demand for cheaper chip makers was already there. So the idea that someone could create a well-performing AI model with cheaper chips only strengthen our conviction that this will be happening probably sooner than we thought. But looking at NVIDIA, a company like NVIDIA is putting out the world's best performing chips, and they're basically selling these chips to the world's biggest technology companies. And these biggest technology companies make up to 50% of their revenue in the third quarter of last year. So basically, these companies are probably not going to settle for cheaper chips because they're looking for disruptive innovations. So I think that NVIDIA itself, the high concentration of these big technology companies in NVIDIA's client book will probably now be all of a sudden a good thing for NVIDIA that could help the company weather a potential demand shock for its expensive chips. And for the other companies, I think that the fact that the idea or the possibility of making well-performing AI models at cheaper prices will simply increase and accelerate the adoption of AI, and it's going to increase the demand for chips. Maybe not NVIDIA's high-end chips, but chips still.
Yeah, and Ipek, I guess one of the other questions is that, we've long heard that some of the big companies want to do their own chips. So if there's a way of doing the same models with cheaper chips, is it easier for some of the big tech to go into that space and win?
Well, I think that one of the biggest threats for NVIDIA, rather than cheap chips, is the possibility of these AI companies, the ambition of the biggest technology players like Google, like Meta, to produce, to build their own chips, as you say. And in that sense, we really think that, yes, it would be a great thing if they could do that on cheaper chips. But it would be even better if these companies that do have the means to do the best of the best could do that on the best chips out there. So when you're talking about innovation, disruptive changes, well, you maximize your chances of getting there faster by using the best tools out there. So I don't think that these companies will be willing to settle for cheaper options just because it costs less. But it all depends on how investors see it, of course.
Ipek, thank you so much for joining us. Ipek Oskar-Deskaya, their senior analyst at Swiss Quote, on the very latest, of course, on DeepSeek and everything to do with AI and chips. Coming up, Trump, tariffs, and tech. We discuss all of that with our senior executive editor for Bloomberg Opinion. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
So the dollar strengthened against every major currency after comments from President Trump and his Treasury Secretary renewed concerns over tariffs. Now, it follows a wild day for global markets after progress on a Chinese AI model wiped more than $500 billion from NVIDIA's market cap, raising some difficult questions about America's tech superiority. Now, for more on all this, let's bring in Timothy O'Brien, who heads up Bloomberg Opinion, our commentary arm of Bloomberg News. Tim, thank you so much for joining us. Look, I'm going to call you the Trump translator because you've been following Donald Trump for over a decade. You understand his thinking, 30 years.
Yeah.
You understand his thinking probably more than most. The markets are lost because we don't know what's a negotiating tactic, what's policy. What do you think is Donald Trump's endgame when it comes to tariffs and policy?
Well, I think Trump's been using tariffs thus far as a negotiating tool. The question is, will he ultimately go to the mats and impose onerous tariffs? And I think that Scott Bessent is an interesting case study in that regard, because here's somebody who was, professionally born and bred on Wall Street, asset management, finance. He's at his core, he's a free trader. No one thinks imposing onerous, burdensome tariff regimes is good for trade or the economy. And if the U.S. really embraced this and really took it on full bore, it would be inflationary. And Trump got elected in part because of all the financial and inflationary pressures that landed on the Biden administration. And so they're going to have a moment where if they really pursue this to its end, it's going to have political and economic consequences for Trump and the U.S. economy at home. But Trump is not a rational actor often, and a lot of what he does is performative. He likes to be an agent of chaos, and that makes him unpredictable. And businesses and financial markets don't like unpredictability.
But so, Tim, what do you know for certain? Again, I've been told, he doesn't want a strong dollar. He's looking at the star market. Unclear, frankly, what he wants with China right now. Are there three things that you say that, this will absolutely happen or not happen under Trump?
Well, I think you can look across a core set of issues he's already engaged with, both diplomatic and financial, and he's coming out of the gates making bold claims about the use of force, whether it's military force or tariffs or diplomatic force. And I think he's waiting to see the kind of reactions he gets. You've seen a little bit of a preview of this in Colombia with, the standoff over repatriating Colombian migrants back to Colombia. And when the Colombians said they wouldn't accept them, Trump said, then I'll beat you with a tariff. And then they changed their tune. Now, Colombia is a small economy, and it's a small partner. I don't think you'll see Canada and Mexico respond the same way, or China. And those are really the three big ones. China and Mexico Canada and Mexico jointly are bigger trading and more important trading partners to the U.S. than China. And they're also proven allies. So the fact that Trump is going at two nations that share the border with the United States and our massive trading partners at the expense of both countries' economic interests is not about long-term policy. I think it's about short-term positioning.
Tim, what's Greenland about? So, I mean, I'm reading copy about, can NATO act against one of its own members if he actually goes into Greenland? I mean, is this crazy talk?
Yeah, it's crazy talk. Both Greenland and Panama, the Panama Canal, I think also are performative. Someone got in Trump's ear and said these are emblematic of the Great Game, and China has an interest in the Panama Canal. Greenland has national resources. It's a passage to the Arctic. You could make a kind of rational case that somewhere in some scenario it makes diplomatic sense, but it really doesn't. And anyone who's sophisticated about this knows that. So I think the issue again is how long does he play at that game?
Who does Trump listen to on any given day? I mean, I heard, again, the chief of staff is actually very good at shutting him off. Elon Musk, I think, does not have, an office in the West Wing because of her.
Yes.
Does he listen to her, or does he listen to others?
Well, I think he listens to her about scheduling, and he listens to her about access. But remember, Donald Trump is someone who doesn't really listen to anyone else. He famously said, "I know more than the generals." He recently said he's a better judge of where interest rates should be than the Fed chairman. He likes to present himself as the final expert, and he usually is. So no one really has a final say with him, but he's got a much more tightly managed administration this time around. Yeah. I think they're trying to be more on message. They're trying to prevent random access to Trump. Yeah. People used to be able to just call him up on the phone and get him. Those days are over. But he's still not really somebody who takes advice. You know
what I heard in Davos over and over? I just don't want to be in the eye of the storm of the president, yes. Right? The chief executives are just trying to lay low.
Well, I think in Trump 1.0, the business community watched Tim Cook and how he navigated Apple's interests, especially Apple's relationship with China as a manufacturing partner, and he managed that by essentially kissing up to Trump. And on the diplomatic side, you saw Macron. He hosted Trump in Paris. He gave him a nice parade. Trump gave him a pass on some things. So I think coming in this time around, everyone's kissing the ring. The problem with Trump is once you kiss the ring, he tries to squeeze you for more.
Okay, so interesting, Tim. Thank you so much. I could talk to you for another 2 hours, so we'll get you back on. And Tim O'Brien there, who heads up Bloomberg Opinion, or commentary arm of Bloomberg News. Up next, to Bloomberg Brief, Danny Berger and Manus Krani in New York, and this is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure. And there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's start that agenda.
Tariff risk rises. President Trump calls for a much bigger rate than the 2.5% floated by Bessent.
In the very near future, we're going to be placing tariffs on foreign production of computer chips, semiconductors, and pharmaceuticals to return production of these essential goods to the United States of America.
And the trillion-dollar wipeout driven by DeepSeek pauses, NVIDIA steadies.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
And Microsoft joins a lineup of TikTok suitors for its U.S. operations, according to President Trump. Good morning, Manus.
Danny, good morning. It's a battle for the oxygen, isn't it, between DeepSeek and the tariff risk. Right now, we have a bounce back in stock, indelibly etched on our mind. Nearly $600 billion worth of a wipeout on NVIDIA. It bounces back this morning. Ray Dalio, I mean, there's a line from him. This is an AI bubble. But Nassim Taleb, the author of Black Swan, of course, talks about the fragility of the structure of these markets. $200 billion bounce back in NVIDIA helps the NASDAQ bounce back. Bonds, 10 basis point rally yesterday. But what does the bond market now make of progressive, as I would say, progressive universal tariffs? Much bigger tariffs on the way. By the way, we have a 7-year auction today, $44 billion worth of paper. We had a double dose yesterday of 2s and 5s, which went fine. But what is universal gradualism in tariffs? Ground zero, it's the FX market. Scott Bessent, we understand, wants to push the 2.5% every month. Trump wants much more. And down go the currencies. The Aussie dollar down by 0.6%. The dollar is bid. And, of course, the dollar up against the yen.
Yeah, how much of a haven can treasuries be if we also have to incorporate tariffs now into their price? I just want to give us a quick look at NVIDIA itself. Manus, you mentioned it's bouncing back. Not nearly enough to undo the nearly $600 billion plunge it had yesterday. It's up 5%. It responded to DeepSeek, calling it an excellent AI advancement.
Plus, GM is up as it prepares to report its earnings before the bell.
And Boeing shares little change this morning to slightly higher. It will be reporting its full earnings. Had a prelim report earlier last week that showed revenue missed as a result of the strike and its defense business.
And in just a few moments, Peter Oppenheimer from Goldman Sachs joins Danny and I. Later on in the hour, Patrick Armstrong of Perimi Wealth, along with Nikos Staphopoulos of BC Partners.
Manus, looking at the market action, the fact that we're rebounding today, I think is notable. It goes to this idea that yesterday was a bad day, but it wasn't a panic. In fact, it was actually a good day. If you looked at all the other stocks, 70% of stocks rallied yesterday. The equal weighted was unchanged. Maybe what's actually happened in this market, if we've decided, it's not a winner takes all market. It's not these big AI players are going to win. but rather AI is now commoditized, and it benefits more stocks than just NVIDIA and just the Mag 7.
Look, it goes to the view, I think Trump put it very well. This is just a wake-up call. We can argue as to whether there was something more malevolent around the release of DeepSeek a week after you had Stargate released in the United States of America. But my favorite line, you mentioned it yesterday morning, it's from Satya Nadella and a host of other people, and it is the Jevons paradox strikes again. As AI gets more efficient, accessible, the use will skyrocket. That's the commoditization.
Well, so this idea of Jevons paradox, I think it's worth an explanation because it is a little bit wonky. The idea is that as efficiencies increase, the use of resources goes up, not down. Example being, you had the Industrial Revolution, steam power gets more efficient, more energy is used. In Japan, they make more efficient cars. Oil usage goes up, not down. So all these energy companies that sold off, maybe that is overdone because we could just see more demand for data centers because more people are using AI.
And I think Kathy Wood was with us this morning in Europe, and she talked about the cost, the actual cost of inferencing, the cost of training, all dropping aggressively. And this is about the landscape shifting aggressively.
Well, elsewhere in Manus, the other thing for this market to grapple with, President Trump's latest vows on tariffs.
We'll also be placing tariffs on steel, aluminum, and copper, and things that we need for our military. We have to bring production back to our country. The incentive is going to be there because they have no tariff whatsoever. In fact, they have help from us if they build their plant in America. And we're going to look at pharmaceuticals, drugs. We're going to look at chips, semiconductors, and we're going to look at steel.
President Trump there was responding to a question about a report that his newly confirmed Treasury Secretary Scott Bessent is pushing for new universal tariffs on U.S. imports, starting at 2.5% and then to rise gradually. Trump said that he wants to enact much bigger tariffs. Let's bring in Bloomberg's EMEA News Director Rosalind Matheson. Roz, he also talked about very specific industries he wants to clamp down on. He's given himself the February 1st deadline before. Has this moved the needle? What difference did the comments he made set? What difference did the comments he made make on the whole tariff conversation?
Well, it's clear through all of this. There's lots of back and forth, and as you say, it seemingly contradictory comments at time. But the thread that runs through all of this is that Donald Trump really wants to keep tariffs on the table, whether it's as a negotiating tactic, whether he intends to follow through with blanket tariffs, whether it's a more specific arrangement, whether it's a gradual arrangement. He wants to have that in the toolbox, and he's going to use it very much, as we saw the other day on Colombia, as a political tool. And it can happen very quickly, and then it can reverse very quickly. And it was interesting to see on the back of those, the conversation about whether they would be gradual. I mean, our own reporting early this month said that there were a number of advisors very close to Donald Trump suggesting that this be a gradual thing between 2 and 5% going up on a monthly basis, and very much that Scott Bessent was part of that conversation. But Donald Trump seemingly really wants to keep countries and companies on edge by saying, hang on, I'm not so sure about gradual. I want the option to be able to go fast and heavy if I want to, and very much targeting those sectors you talked about. Autos, that's been one for him before in his prior administration. Steel's obviously come up very much for him before, but also pharmaceuticals, and that might put a bit of the pharma sector on edge in particular.
It's interesting, Ros, that we have this universal gradualism espoused by Bessent, but then you look at the other side, you've got Navarro and Jameson Greer. It's almost as if the hawks are in abeyance just at the moment. Trump wants one thing, but Bessent wants to roll out a progressive universal process. So again, a very divided house.
Well, that's right. It's going to be that question of who gets Trump's ear and who does he listen to in the minute, and does, he's famously known for being paying attention to the last thing that he hears in a room. Are you the person who gets that last word? And is that Scott Bessent, the voice of gradualism there? But you are perhaps having hawks who are leaning very much into Trump's rhetoric, whereas others are arguing for caution. I mean, in the end, in all of this, Trump can be pragmatic. He's a deal maker. He's a businessman. He does change his mind if he thinks it's a better outcome to do so. So he can be flexible. The question is, can you be the person who argues for reason in the minute? So how much Scott Bessent has his ear is going to be interesting, because Scott Bessent will need to deliver, particularly on the tax front. Domestically, that's going to be very important to Trump, that's clear. So how much can he show he's enacting a little bit, at least, on Trump's agenda early? That's going to be really important.
Yep, it's, as Terry Haynes has called it, a team of rivals. We'll see who wins out. Roz, thank you so much. Roz Matheson there. Let's get you some other stories now that are trending on the terminal this morning. In an internal memo to staff, HSBC said it will wind down some of its investment banking operations in both Europe and the Americas. Instead, it will focus more on Asia and the Middle East. All of that part of the CEO's ongoing restructuring of the lender. An HSBC spokesperson confirmed the contents of that memo.
Bloomberg sources say Prime Minister Netanyahu is planning a visit to President Trump in Washington next week to discuss the ceasefire in Gaza. Skeptics have questioned whether the deal will hold, though its second phase, which should lead to a permanent end to the war. And the trip is not finalized and may partly depend on Netanyahu's health after recent surgery.
A majority of workers at a Whole Foods market in Philadelphia voted in favor of joining a union. It's the first time employees of the Amazon-owned grocer have organized in decades. The vote was passed 130 to 100, with workers pushing for higher wages and improved benefits.
Coming up in the show, tariff threats loom large. More on that and the shape of this market, a bounce back on NVIDIA. All of that to come on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rise in course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Brief. I'm Manish Krenny alongside Danny Berger here in New York. So DeepSeek-driven sell-off, it wiped out almost $1 trillion in market cap of the Nasdaq's 4 biggest companies. NVIDIA alone saw a $600 billion wipeout in its market cap, marking the biggest fall in a U.S. stock market history. So is it time to buy the dip? That terrible question. Peter, good morning to you. Peter Openshaw is the Chief Global Equity Strategist at Goldman Sachs. We'll get to buy the dip in a moment. $1 trillion wipeout. You've seen many a fractious moment in these markets. Tell me what you saw yesterday and what it signaled to you, and what did you say to clients?
Hi, Manus. Yeah, well, I think that the first thing to say is that this needs to be seen in context. These stocks, of course, have had a tremendous rise, dominating the market over the last year or two. Roughly half of the S&P's return came from the biggest 5 stocks through the course of last year. And it did reflect and continues to reflect their very strong fundamentals. But of course, it's not just about outcomes, but outcomes relative to expectations. And I think as people came into the year, their confidence in the continued dynamics of these dominant tech stocks continuing to drive the market was probably too high. And so they were vulnerable, I think, to any setback in expectations, and that's really what we've seen.
But then we come back again today, Peter. I know we haven't fully made up of the damage that we had yesterday, but the irony of it is that these were the stocks that people had been fleeing to safety. It was seen as a safe part of this equity market. Do you think yesterday will force a change in investor behavior? That constant buying of the dip, constant buying tech is the only thing, the U.S. exceptionalism. Did all of that change yesterday?
Well, I don't think it did, because fundamentally the US exceptionalism story, which has really been dominant since the financial crisis, has reflected fundamentals. The US stock market has outpaced others in terms of its underlying profit growth, largely led by technology, which has outpaced other sectors. And of course, the dominant companies have been the key beneficiary of that. None of that has really changed. But of course, markets have become historically concentrated, and optimism going into this year was extremely high, and that leaves them vulnerable to a setback. But I don't think it really changes the underlying fundamental story, and we shouldn't lose focus on the fact that the global economy, and the US in particular, remains pretty robust, and interest rates are coming down, and those are underlying foundations that we think are still pretty supportive for the market, and indeed the tech sector.
Then on a relative basis, Peter, with those pillars underpinning the market, is it a moment where breadth, equal weight did fine yesterday, the Russell held up relatively to the rest of the market? And I know that there's been many a proponent of go for breadth, go for a little bit more diversity and defensiveness. Does that not just provoke that move, but it pushes that needs to be the top priority?
Yeah, absolutely. And this has been a key driver of our own recommendations over the course of the last couple of months, recognizing that the underlying fundamentals from a macro perspective are positive for equities, but at the same time, there's significant risk in the degree of concentration that we've been seeing. And we have been recommending looking at diversification strategies, including hedging, including looking at the equally weighted S&P or the S&P 400, looking at companies that are quality growth compounders outside of the tech sector, and also looking at a little bit more geographic diversification as well. And so those have been sort of central drivers of our own recommendations, and I think that still makes a lot of sense in the context of this setback that we're seeing.
Which, by the way, if you'd owned the equal weighted index yesterday, you would have actually slightly gained. Peter, we had this event that really upset markets, and it wasn't even on the calendar, and we have so much more for the rest of the week. You have Microsoft and Meta earnings tomorrow, then you have Tesla earnings, you also have a Fed decision, an ECB decision, not to mention a President Donald Trump who every day seems to have a different word to say on tariffs. How fragile are we for all of these different things that are being thrown at the market?
Well, I think we need to differentiate here between structural vulnerabilities and vulnerabilities to a correction. Again, we shouldn't lose sight of the fact that the global economy remains in pretty good shape. The US in particular does. And we are seeing some progress on inflation moderation, and interest rates are likely to continue to ease. When we've seen that combination of factors in the past, it's been broadly supportive for equities. But the last couple of years have seen one of the strongest rises in equities in history, with very low volatility and very high concentration, and that does leave markets vulnerable to a correction. I would say this is a correction, not a bear market, and the drivers of diversification are beginning to pay off, and I think that will continue to be true for a while now. There's lots of very good quality companies that are not very extreme in valuation, which are growing earnings and dividends pretty nicely, and that diversification should be seen both across the technology sector, across different sectors, and even different geographies. It's interesting that Europe has been the best performing stock market so far this year, an area where people had very little confidence at the end of last year, but again offers a lot of good value and selectively some very good quality global companies that are seeing earnings growing.
Peter, really wonderful to catch up with you this morning. We are happy you survived the wreckage of yesterday. Peter Oppenheimer, always with a very sound take of Goldman Sachs. Coming up, Microsoft in talks, potentially, to buy TikTok. at least their U.S. operations. That's according to President Trump. Bringing the details coming up on your brief.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
You're spoken, sorry.
My voice and my conversation, my poetry, you know.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot,
on beer and groceries and gas and video games.
And
I wish I had
hogs.
kept it. I wish I would buy a Harley today if I had.
Yeah, but you
that
probably wouldn't
Bitcoin.
be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
It's Bloomberg Brief. I'm Manus Crane alongside Danny Berger here in New York. Front page news. This is what's making headlines around the world. First up, we've got the New York Times. They lead with the White House ordering all federal grants and loans to be paused. Now, the memo from the Budget Office signaled it would continue until at least February. The OMB acting director said the pause was needed to ensure federal programs aligned with the president's policy priorities.
Next up, the Washington Post reporting that Palestinians are traveling back to northern Gaza after months of being displaced during the Israel-Hamas war. The mass migration began after the second round of hostage-for-prisoner exchanges that took place over the weekend. A spokesman for Hamas said that it is a message of defiance to any new attempt to displace them.
And Bloomberg leads with President Trump saying that Microsoft is in talks to acquire, you got it, TikTok. He addressed the gathering of Republican lawmakers in Florida.
I became a little bit jaded toward TikTok, but we'll see what happens. We're going to have a lot of people bidding on it, and if we can save all that voice and all the jobs, and China won't be involved. You don't want China involved, but we'll see what happens.
Tom Kenzie's tracking the story for us. Tom, good to see you. Microsoft formally being entered the fray by the president. This isn't their first rodeo. 2020, Satya Nadella was there. I think he said it was the strangest thing I've ever worked on, but he's back at the table.
According to President Trump, he's back at the table. According to President Trump, he's back at the table. And as you correctly say, not a big surprise.
if indeed that is the case, given that Microsoft and Oracle were looking at TikTok back in 2020, before, of course, that was derailed by the legal challenges that previous attempt by Trump to ban it faced. So, amongst the names now, Microsoft, we haven't heard about Oracle, we have heard about Microsoft, we've heard about the AI chatbot company Perplexity that is making a lot of progress. They put in an official bid. We've had a bid as well from Frank McCourt, former owner, of course, of the LA Dodgers. And then, of course, the Bloomberg reporting that possibly Chinese lawmakers are weighing up Musk, possibly through X, buying TikTok. So those seem to be the names at play right now. The president says he loves a bidding war. He wants to see how this plays out. He signed the executive order, of course, delaying the ban of TikTok that would have come through on January the 19th. That is a 75-day process. The timing is there. They've got to work through this pretty quickly. These seem to be the main names now bidding for this potential asset.
Tom, the thing I always keep coming back to, though, whenever we get any of these new names is, does TikTok actually want to sell itself? I mean, they've had since last April. It doesn't seem that time is the issue for them.
They were constructive on this idea back in 2020. They've been very clear, ByteDance, the parent company based in Beijing, been very clear that a sale is not what they are looking at right now. And then, of course, there's arguably the more important question, which was, how does Beijing itself think about this? And since 2020, they've put in place legislation and law in China around national security and export control laws, both of which would likely hamper the sale, particularly the transfer of the algorithm that sits in China to any US buyer of this. How valuable is TikTok without the algorithm is an important question, because that is the secret sauce of this company. It's very hard to see, most analysts would say, very hard to see how China would allow that algorithm to be signed off and sent over to the US as part of this deal. All of this, of course, wrapped up in the geopolitics, in the brinkmanship between Trump and Xi Jinping in terms of how this relationship unfolds. It will be potentially a source of leverage for Beijing going forward. So far, they've got no indication they want to sign off on the sale of the algorithm.
Tom, thank you so much for that and for all of your coverage already. A busy start to the week for you. Bloomberg's Tom McKenzie there. From tech to tariffs, Trump wants more than 2.5% as floated by Besant. What do you get? You get dollar strengthening versus the euro. It's up quite a bit this morning. Euro weaker by more than 0.5%, Manus.
Indeed, and this is the debate in the FX market. And we see these reaction functions immediately. Every time we talk about tariffs, whether it's going to be the 2.5% that we understand Besant wants, or is it going to be something much more? And ground zero in the trade wars is going to be Australia. Australia, in terms of their relationship with China, that is the biggest sort of delta FX in this play. And then you can see the dollar up against the yen as well. Everybody's in the sideline. This is about reshaping supply chains, commodities under pressure.
I mean, it just goes to show you can have a big strengthening of the yen yesterday in this flight to safety after the tech wreck. Yeah. And that all can be undone with just a few words from President Trump. Okay, coming up, we're going to get back to that tech wreck, the AI emperor exposed with no clothes, or is it an overblown panic? We're going to catch up with Patrick Armstrong of Plurimi Wealth. All to come on your Bloomberg Brief.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was It was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger here alongside Manish Krani. Let's set your agenda.
Tariff risk rises. President Trump calls for a much bigger rate than the 2.5% floated by Besant.
In the very near future, we're going to be placing tariffs on foreign production of computer chips, semiconductors, and pharmaceuticals to return production of these essential goods to the United States of America.
The $1 trillion wipeout driven by DeepSeek pauses. NVIDIA steadies.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
And Microsoft joins the lineup of TikTok suitors for its U.S. operations, according to President Trump. Danny, good morning. It's Bounce Back Day.
Well, it was a bad day yesterday.
It was.
Not a panic, and maybe that is underscored by the fact that we are bouncing back 0.7% for NASDAQ, and we're looking at NVIDIA rebounding about 5%. That doesn't completely undo the nearly $6 billion that they lost, which, by the way, if you'd owned the equal weighted measure of the S&P yesterday, you wouldn't have lost any money. So actually a good day for 70% of this equity market. You did see a rally in treasuries as we fleed to havens, but that starts to undo itself with the threat of more tariffs. February 1st is the deadline Trump has given himself. He says he wants more than the 2.5% that Scott Bessent has floated as a universal tariff. You also see dollar strength coming this morning, too, as a result of that. Now, it's the morning after the markets woke up to the release of R1 from DeepSeek, something that sent shockwaves through Silicon Valley and Wall Street. Tech executives reacted to DeepSeek. NVIDIA's Jensen Huang, maybe a ground zero of the reaction, saying it's an excellent AI advancement. OpenAI, Sam Altman, calling it impressive, particularly around what they're able to deliver for the price. And Microsoft Satya Nadella tweeting that users of AI will skyrocket as it gets more efficient. Investors have been reacting as well. Here's what ARK Investment Management CEO Kathy Wood had to say.
We think platform as a service, so think Palantir, is going to gain significant share. And this news yesterday, I think, highlights that. We think infrastructure as a service is going to stabilize the share. Software as a service will come down a share. However, I've said all of that. All of them will be growing rapidly. It's just how rapid.
Let's bring in Bloomberg Intelligence Senior Analyst Mandeep Singh. So Mandeep, things are calm in the market now, so we can take a step back and stop the whole freak out. As we kind of assess what's been falling, what's been under pain, what reactions look overdone to you, or what is justified in kind of the freak out of yesterday?
Well, look, I think what we have seen now is clearly move towards, bringing down the inferencing costs, even the training costs, and anyone who is planning, to build a bigger cluster. So the biggest cluster right now is a 100K GPU cluster. people have been talking about building 1 million GPU clusters. I think they will be rethinking, the plans around building larger data centers, writing checks for, training that are north of $1 billion, because frankly speaking, the focus will move towards hardware efficiency going forward, simply because what DeepSeek has shown is you can do a lot more with, spending a fewer dollars upfront and focusing more on inferencing. And I think open source has been validated. So I expect a lot of software companies moving towards open source as a result of this. Maybe some of these foundational labs that haven't gone the open source route may start rethinking about using some of their models and putting them out for open source use.
How does the pressure landscape change here? Danny and I have been talking about this in terms of the open source, the Gemini model, relative to Sam Altman. Sam Altman obviously closed. He said it's an impressive model, and we're going to have to deliver much more. More pressure on Altman, and perhaps an escalation up for Google?
Absolutely. I think for someone like OpenAI, clearly, not having to spend a lot of money upfront on training their next model, GPT-5, is probably a good thing, but they are involved in Project Stargate. So, they have been touting that the next model will be a lot bigger and it requires much bigger investment. At the same time, Gemini, I feel, has been focused more on lowering the cost per token. That has been their approach. So from that perspective, I think they'll feel much better about what happened yesterday. And look, they have the largest AI deployment when it comes to their search business, the traditional search, where they've been adding Gen AI overviews. Well, lower costs help them, stabilize their margins and questions that were being asked about what it does to traditional search margins. So from that perspective, I think it helps Google.
Perhaps as the dark horse and the winner in all of this wipeout, trillion-dollar wipeout yesterday. Some reprieve this morning. Mandeep, thank you very much. Mandeep Singh from Bloomberg Intelligence. Here's a take from Patrick Armstrong, Plurimi Wealth. He says this: DeepSeek may have exposed the emperor with no clothes, and revealing that immense AI budgets might not guarantee superior results. Pleased to say, Patrick joins us now, CIO of Plurimi Wealth. Look, what did we learn yesterday? Who is swimming naked? And do you think really it's more about that impenetrable moat around NVIDIA has been breached?
That's exactly it. I think NVIDIA remains an incredible company today. The profit margins that we had discounted out for the next 7 years, you have to accelerate the decline in profit margins based on what we've learned over the last week, that NVIDIA is still the leading processor. It's going to get billions and billions of spend, but there are cheaper ways to do it. And it's definitely hurts NVIDIA's valuation, not because anything's changed with NVIDIA, but because there will be competition, lower cost ways to do things, and that'll probably lead to less sustainable, really incredible profit margins they're generating today.
Patrick, I just wonder what you make of the timing and the freak out of all of this. I've been speaking about this morning, this idea that Gemini from Google has been doing something similar, just no one's been reading the research. That is trying to bring costs down. Mandeep was just talking about it, using a very same method, very similar method to what DeepSeek is doing. What does it say to you about the fragility of this moment, that we can get the thing released last week, we're just ahead of tech earnings, and you have that level of wipeout occur on this equity market?
The level of wipeout was incredible, but the run-up was also incredible. So we've probably given back several months of NVIDIA's performance, and I think it's perfectly reasonable. I owned NVIDIA last week. I'm continuing to own it today. I sold put options on it, March $110 put options, as a mildly bullish strategy, just thinking that the sell-off is overdone. But it has changed. NVIDIA's future profitability isn't going to be as strong as I thought it was last week. This definitely is going to hurt their business model, but it's not destroying the business model. When I referred to Emperor's clothes, that was a bit of a strong metaphor. It is impacting profitability, but it's not destroying the profitability. It is still an incredible company. And I think the market, 10% sell-off, made perfect sense to me. I think it did get a bit overdone yesterday, though.
We like strong statements here. Talk to me about the geopolitical ramifications. Any other 2 days, we would have been talking, first of all, about tariffs, but the geopolitics of this acceleration by China in the AI space. Donald Trump says it was a wake-up call. Geopolitically, what are the ramifications?
It probably is a wake-up call, and it's also shown potentially the ability to do it, that some of the restrictions about getting the NVIDIA processors and chips, they may not have been as effective at stopping potential geopolitical adversaries of the United States of developing the AI and the large language models. So there's a lot of ramifications across profitability, across the political framework, and Trump never misses a chance to have a bargaining chip, and I think access to technology is going to be part of his discussions with China, so there's nothing surprising there.
Patrick, again, you're talking about some really big consequences. You yourself have had a reappraisal of how you're viewing NVIDIA and future profits. Why then is the market rebounding today? There were so many people talking about yesterday that this is a sea change. This challenges U.S. exceptionalism. We need to rethink these valuations. Yet plenty of people are willing to step in and buy the dip this morning.
Well, it was such an extreme move that the valuations of NVIDIA this time 2 days ago were 35 times 12 months forecast earnings. Today, or yesterday, was trading at 26 times. So the sell-off was all multiple contraction yesterday. We'll see if the earnings revisions do get revised lower. We'll get some guidance on that as the big companies report this week. I don't expect they'll really be acknowledging a change on their spend. If you are going to want to develop this and be the leading edge, you are going to have to spend the tens and hundreds of billions. But there will, underneath that area of innovation and leadership that the big companies will probably want to get to, there will be a second tier of Me Too companies that can do a pretty credible job at rolling out things as well.
Okay, well, you're brave, right in the put options there, Patrick, but you got the bounce back, so you get a nice tail behind you this morning. Patrick Armstrong, the CIO of Plurimi Wealth. Other stories trending on the Bloomberg terminal this morning. This is what we've got for you. President Trump wants to impose across-the-board tariffs that are much bigger than the 2.5% to reshape the U.S. supply chains, threaten tariffs on specific sectors, including semiconductors, steel, copper, and aluminium. Trump also strongly suggested he could also impose them on automobiles from Canada and Mexico.
Scott Bessent has been confirmed as the next U.S. Secretary of the Treasury. He won a Senate vote of 68 to 29. Besides the support of all Republican senators, he also secured the backing of 1 independent and 15 Democrats. The former hedge fund manager now becomes Trump's 5th cabinet pick to get confirmed.
And in an internal memo to staff, HSBC said it would wind down some of its investment banking operations in Europe and here in the Americas and focus more on Asia and the Middle East. It's all part of the CEO's ongoing restructuring of the lender. A HSBC spokesperson confirmed the contents of the memo. Coming up, we're going to turn to the world of private equity. We've got the BC Partners chairman in the house. That's next on Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. when you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
I guess the rethinking is probably more along the lines of how do you essentially avoid just continuing to put more and more money into the US? There's been lots of initiatives that's drawn capital into the US. The markets have been very hot, as we all know, the last couple of years. You know, we try to run a diversified international portfolio. So in some ways, it's actually, you know, where in the rest of the world do you see growth and do you see a return on the risk you're going to take?
That was the Ontario Teacher Pensions Plan CEO Joe Taylor speaking with Bloomberg at Davos. Joining us now is the perfect voice on this. Where do you want to be invested? It is Nikos Stathopoulos, chairman of Europe at BC Partners, with a firm has 40 billion euros of assets under management. Nikos, so great to speak with you. And I wanted to talk with you specifically because everybody is just so gung-ho, the U.S., American exceptionalism. There we had Joe Taylor saying, people are overlooking the rest of the world, and there are opportunities to be had in Europe. Do you think that's right? Are investment funds ignoring Europe? Is that where the fertile ground is right now?
Well, it's great to see you again as well, Danny, as always. Yes, I think there's a lot to do in Europe still. Europe is not growing as fast as the U.S., which is always the, call it, criticism that we're getting. But it's a complex space. It's still very fragmented, but there's still a lot of opportunity because you do have local champions, you have European champions, you have companies which are exporting, companies that are very active and doing very well. As long as people can navigate the European landscape, which is complex, as I said, it's diverse, it's not one country, then we do think there's still a lot of opportunity. If you look at the deal activity that happened last year, Europe was up about 70% in terms of deals done, and therefore I still think there's a lot of opportunity to invest in Europe and make good returns.
Yeah, especially again if everybody is ignoring it and just focusing on the U.S. Nikos, you mentioned this idea of exporters, which of course, especially if you're selling to a market like the U.S., that's fertile ground. But how do you assess just the fire hose of information coming out of the Trump White House of not yet tariffs, but threats of tariffs? Does it make you rethink any exposures or potential deals?
It does, and naturally, you know, every other day we hear new tariffs being announced and everything else. And I do think that this is probably the biggest concern at this moment that as investors and certainly as European citizens, people have. Now, having said that, if, how, and when these tariffs will be implemented is still uncertain. But now, naturally, we should brace ourselves for these. And it does impact the industries that we look at and we look to invest in. Certainly, we at BC Partners are not that exposed, at least, to the tariffs or to the industries that President Trump has been announcing, like automakers, et cetera. But it's true that, as I said, every other day there will be a couple more industries that this will impact. The beauty of our industry has been that we are patient capital, we're very diversified as investors, and therefore we don't need to invest in certain industries if we think that these will have some headwinds. But tariffs will impact indeed where we invest, how we invest, and probably the timing of when we invest.
Nico, good morning to you. Let's just take that a little bit further. I mean, you look at, as Danny said, you know, fire hose of policy. The exit market was presumed to have thawed, and it was going to be a great storming year for everybody. Do you think that that's dislocated now? Do you think that that's pushed back with the level of policy uncertainty pretty much on a daily basis at this juncture?
Yeah, well, listen, the exit, you're totally right, Manu. So the exits has been a focus of private equity forever, but even more so, frankly, in the last year or two, because our investors are demanding liquidity, and rightly so. 24 was a relatively low year of exit overall. I mean, we have been fortunate to have had probably our most active exit year with about 12 billion euros return to our LPs in 2024. But that's certainly, I would say, priority number 1, 2, and 3 at the moment in the private equity industry. There's been a lot of over-allocation in the sector from some of our LPs and our investors, and they're looking to get money back before they actually reinvest back to funds during fundraising. So exit will be a top priority. I do think that announcements like tariffs and everything else that we hear recently will potentially curb some of that activity if they impact the sectors that we're dealing with. But I also think that Europe will end up having to pivot as part of these announcements and address its competitiveness, its bureaucracy, its taxes, and other things that have been criticized, and potentially rightly so, by our U.S. counterparts. But I do think exit will be a top priority at the moment.
Nikos, that last point's really interesting. Someone put it to me that Trump is making Europe great again. I mean, you heard it in Davos, right? A lot of policymakers, even Christine Lagarde, talking about the need for a more competitive Europe. How does that actually happen, though? Because you have had things like the Draghi report, and Europe has yet to come together. Do you really believe that that is the future for Europe, a more competitive group of nations?
There's no doubt in my mind that Europe has to address its competitiveness. And as I said, even though we don't like some of the tariffs that are being announced, or the intentions or the rhetoric that we hear, I do think it will put pressure on Europe to act. How it's done, I'm not a policymaker myself, but I certainly think that focus on regulation, or deregulation for that matter, focus on taxes, focus on bureaucracy, focusing on staff and labor and staff shortage in some industries, will have to be there. And even we may not necessarily like it, we do know that Europe is growing less than the US in terms of GDP growth. But I don't think it's just one KPI. It's not just one metric that people should look at. Is the overall picture. And ironically, I also believe that I think that the tariffs will focus and make us potentially a more competitive continent. And I'm talking about this side of the pond.
Well, certainly Trump won forced an entire rethink on defense, and it's provoking a number of rethinks. Let's try and see where you are in terms of deals. EuroLeague basketball, Danny and I were chatting about this before we came on. You've edged out the rivals, General Atlantic and Saudi Arabia. How did you manage that? Saudi Arabia has got deep, deep pockets.
I think a lot has to do with our knowledge and experience in the media landscape. We've looked at sports as an industry for a very long time. It's become almost a $1 trillion industry. I think that ecosystem, however, is very complex. I do think it needs to be institutionalized. And I think with the evolution of that space, especially on the media side and the technology side, it needs investors who really understand it and who can actually bring value. I think the way we managed to get these exclusive discussions that we're currently with EuroLeague is because I do think we're bringing apart from capital, of course, that many people have, is that media expertise and that understanding of how to monetize and commercialize content more efficiently, which I do think in European basketball in particular, although other European sports as well, is behind our counterparts in the US.
Nikos, can we break a little bit of news here? I know you're in exclusive conversations with EuroLeague, according to reports. Can we expect a deal anytime soon?
Sometimes, as you can imagine, it's not necessarily up to the buyer. It's also up to the seller. And leagues are complex, and it includes several clubs. So I hope we will be able to get to the finishing line, but it's not just up to us.
Nikos, fair enough. Well, we wish you the best for it and hope to see you courtside at the EuroLeague. Nikos Stathopoulos of BC Partners, thank you so much for joining us. Manis.
Coming up, we've got a host of earnings on deck. We'll take you through and set your agenda for you in just a moment.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Let's get you set up for your trading day on this Tuesday. We're going to get earnings from Boeing, General Motors, and Lockheed Martin. All of that comes before the market open. Then some data, durable goods orders. That will come at 8:30 a.m. Eastern, then followed by Conference Board consumer confidence. That comes at 10 a.m. Then we got some more earnings. Starbucks reports its earnings after the market close. And by the way, after the year market close, we will be getting LVMH. Manis.
Danny, it's a battle over the oxygen this morning between the tariffs and the tech post that deep seek. Right, you've got a bounce back on NVIDIA, 5.33%. $600 billion wipeout this morning, $35 billion per 1%. So we're up about $200 billion there. Broadcom also gaining, having lost nearly $200 billion yesterday. So there's this moment of reprieve on $1 trillion for the top stocks in the US wipeout yesterday. Arista Networks, let's just close it off with that. They're down. They had been down 22% in the last session. So again, it's this sort of palpable relief in this market at the moment. But of course, there's the other major story. It's about the scale of tariffs and what cadence will we get.
It's so true, Manis. If we hadn't spent all yesterday freaking out about DeepSeek, we'd be talking more about the board behind you. That is a dollar that is strengthening. And President Trump, when asked about the reporting on Scott Bessent wanting 2.5% universal tariffs, he says he wants much higher. Manis, he's given him the self-deadline of February 1st. That's Saturday.
That is Saturday, and that's really going to shape the night. Just think of what you've had. We've had 60% risk of tariffs, 25% tariffs, 25% tariffs on Colombia, and then it was rolled back all on Sunday afternoon. So if you want to understand universal gradualism, it may take more than between now and Saturday to get it there.
I mean, it very well might, especially considering he only just got his Treasury Secretary confirmed. Okay, that is it for Bloomberg Brief. Surveillance will take the reins from here on this Tuesday. DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Maybe the Mag 7 aren't as dominant as they have been. I don't know that that's a bad thing.
The game's going to continue to change as far as kind of the AI ecosystem is concerned.
The Mag 7 stocks are 34% of the S&P. We're all tied to these 7 stocks, and in particular, we're all tied to NVIDIA.
I do think it's a threat to the expectations that we had coming into this year.
It certainly looks like a fairly tough year for investors. US exceptionalism can persist, probably not to such a significant degree.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, following a steep, DeepSeek-inspired sell-off in the equity market, looking to bounce on the NASDAQ 100 from the biggest one-day sell-off of the year so far. NASDAQ 100 futures right now positive by 0.6%. The main event yesterday, one single name, NVIDIA. NVIDIA getting absolutely hammered in yesterday's session, down by 17%, a record $593 billion taken off the market cap. This is your very small bounce, Lisa, in comparison to that big sell-off. We're up 5% in the pre-market.
There's still some big real questions that people have about whether we have overplayed how much investment in chips really is necessary to generate some of the large language models that people were talking about could be transformative. It is interesting that this was basically a reversal of everything that we had seen over the past 6 months, which is that big tech sold off. NVIDIA, the former leader, was the big sell-off. Everything else did okay, and that was more interesting that the S&P equal weight was pretty much flat.
Totally unchanged, slightly positive. I saw the same thing. Kind of bizarre that the rest of the equity market was kind of okay, had a decent day. But I think what yesterday really gave us was a decent read on the scale of how much is in the price, not just in the tech players, but elsewhere. Nat gas was down yesterday, not just weather-related. It wasn't just front-month prices, it was longer-dated prices too. Nat gas was down about 8%. Nat gas producers, the likes of EQT, we caught up with them last week, down 10%. Pipeline operators, Kinder Morgan, down by 9%. Utility companies, Constellation Energy, which has had a massive run-up, was down by more than 20% in yesterday's session.
And I think that you framed it well. It highlights how everybody jumped on this narrative that the build-out was basically the more the better, the more money you spent, the more chips you bought, the more energy you invested in, the more you would be returns, you would get those returns, and that is what happened until yesterday. And so now you have the likes of Rob Arnott, of Research Affiliates, of Ray Dalio coming out and basically saying, well, it was a bubble, and we basically are seeing that, and it's 2000 all over again, and welcome to the new reality.
It's not a quiet start to 2025. Got to be across a few stories already this morning, and not just this one, also the trade story. Check out the dollar. Let's look at euro dollar. Euro dollar last week had its biggest weekly gain going all the way back to 2023. So that's euro strength and dollar weakness. Reversing some of that on the session today. Euro dollar down to 104.26, negative 0.6%. Trade is back on the agenda in a big way.
It's back on the agenda, and to be honest, I don't think it went anywhere. But yesterday, what the market
became very aware of is that potentially this threat of Saturday tariffs is real. Yesterday, Donald Trump was in Miami. He talked about a number of items maybe he'd want to put tariffs on, things like aluminum, copper, steel. And then when asked on Air Force One what he thought about a report in the Financial Times of the newly elected confirmed Treasury Secretary saying maybe we would do 2.5%. This is what the report is saying that Scott Bessent would like to enact when it comes to tariffs. Trump said, no, we would go much bigger than that. And that threat is what is keeping the market on edge.
But it just goes back to something that we talked about in the initial week after Donald Trump was confirmed and inaugurated, which is this is really the guinea pig for all trade policy. The dollar, the currency markets, and how much they can get whipsawed by different competing reports at a time when Trump is saying, I have in mind the amount, but I'm not going to tell you. And by the way, Google has changed the Gulf of Mexico to Gulf of America. You can see that on select programs.
You can see them in select programs in the United States, or you could see both of those being marked if you're international. But what I thought was key in that line you just said, Trump says, I have it in my mind. Jonathan, he has concepts of a plan. The market just doesn't know what they are yet.
Ian Lincoln of BMO put it well yesterday, just in a line. Core uncertainties have yet to be resolved. It's January 28th. Core uncertainties have yet to be resolved. They might not be resolved in the next few weeks either.
Which raises a question, why do people keep trading on this? Why does it elicit such big responses in currency markets when we've already seen with the Colombia tit for tat that essentially it can be used as a negotiating tool that can quickly be unwound? So that's something that I'm watching.
A lot to get through this morning, so let's get to it. Equity futures right now on the S&P up by 0.4%. Coming up this hour, we'll catch up with Peter Cheer of Academy. On the AI-fueled sell-off, we'll speak to John Lieber of Eurasia Group as Trump vows much bigger tariffs, and Matt Bryson of Wedbush following NVIDIA's record market wipeout. We begin this hour with the Nasdaq 100 coming off its worst day in 6 weeks. DeepSeek's cheap AI model challenging the high valuations of US tech stocks. Peter Cheer of Academy writing, I remain skeptical of some of the cheap AI claims, but this moment could be as important to the markets as the unveiling of ChatGPT. Pete joins us now for more. Pete, good to see you. I want to kick off the program with a statement from NVIDIA in the last 24 hours and get your thoughts on it. DeepSeek's work illustrates how new models can be created, leveraging widely available models and compute that is fully export control compliant. What do you make of that last line? Do you believe it's fully export control compliant?
I think that's going to be the really interesting part. Have they subverted some of the things that they're not supposed to get access to, either directly or indirectly, right? There is compute that you can borrow. Have they figured out ways to access that? Or, and this is probably slightly more scary, have they actually been working on their own chips? And we've talked about this before. You can make smaller nanometer chips without ASML technology. It's just very inefficient. And some of the gains that are coming in chip speeds are actually coming from how they package the semiconductors within a chip and how they stack them. That's a much lower technology requirement. So it will be interesting to see, one, maybe this is all just cold fusion and doesn't really exist. Two, maybe there's some other workarounds, but maybe they've actually been developing something that will be very important from a geopolitical and strategic standpoint for President Trump to deal with.
So I wanted to go there. Basically, what the implications are, what it matters, if this is basically something that really did use export-compliant chips and shows a new innovation in terms of efficiency and scale of what you can do versus a new front on the Cold War of technology between the U.S. and China.
So even if it is export compliant, I don't think many Americans, and certainly American companies, will be using Chinese-based AI, right? They're going to do it here. This is open source, so what we should expect is these efficiencies, if they are true, to rapidly evolve and develop within the U.S., right? It's open source. The U.S. can figure this out. We can develop it. I would not recommend any U.S. corporation, using Chinese AI and giving your data to China. We're all sitting there worried about TikTok. This would be far worse, right? TikTok just catches us scrolling through random stuff. This would actually be, what questions are you asking? What's important to you? That would be way more information. So I would not touch that, whether it's export compliant or not.
I think you actually do get a lot of information, particularly about a certain age group when you look at TikTok records. I'm just saying, theoretically. I am wondering, though, and you mentioned OpenAI, that this is a similar type of potential development as OpenAI. A lot of people said that OpenAI single-handedly was responsible for the U.S. not falling into recession post-pandemic. Is there a similar transformative moment here where it basically marks the gap between investing in chips and the broadening out of tech use?
Yeah, I think you'd almost have that reversal. Whatever happened after ChatGPT, you really saw the Mag 7, particularly AI stocks, do very well. Now it might come and spread to the rest of the world, right? If AI is now cheaper to access and develops cheaper, Why not use it more? Why can't more people get involved? So I think yesterday's response made some sense, right? You saw, even of the Mag 7, Meta and Apple did well because this would potentially reduce their spend. I think this is actually probably really good for the economy if true, as the efficiencies will get developed here. It's probably less good for some of the AI chip manufacturers, though you saw Intel, right, I think did reasonably well because that wasn't their, if you can make this with more bread and butter. So I think this is really exciting, interesting, and probably my biggest question yesterday was all the energy sell-off related. Is that overdone? I don't see that this being the end of AI, and I have not done the work yet, and we're trying to assess, is this new cheaper version a lot less energy dependent, or is the energy dependency actually going to be about the same or even increase as more people adopt? So I think the energy sell-offs where I'm looking for some opportunities today.
When it comes to other opportunities, Trump yesterday called it a wake-up call on the fact that the United States needs to be laser-focused, similar to this geopolitical race. In that sense, if the U.S. is going to be more laser-focused, he just announced Stargate. He clearly wants to put more money into this with private-public sector partnerships. Is now a time to buy even the chip makers?
I think certainly, yes. I like the more basic ones in particular, but I do think, we are going to see a much broader extension of, the CHIPS Act, where I think that had a lot of strings attached, the environmental issues, a lot of other issues attached to that money. I think Trump's going to go much more all in and say, we need to make chips domestically, right? We need to avoid how many chips are being made in Taiwan, shipped right past China, and we did a little bit, some of the potential black swan events for this year. What happens if China does some sort of embargo around Taiwan? Our chip industry would be crippled because of that. So I think that's a huge focus. It makes a ton of sense, and it's exactly in line with the sort of thing I think President Trump and Musk would like to do.
You mentioned the energy piece of this, that maybe you'd look for opportunities today. Let's dig into that. Is it the commodity producers, the energy infrastructure players? Where would you look first today?
I would not probably touch the commodities themselves necessarily. I do think that, drill, baby, drill, or better yet, refine, baby, refine is going to be the mantra of this administration. We're going to pull more things out of the ground. We're going to process them domestically. Again, it's ridiculous that when we take, oil out of the SPR, we have to ship it overseas to turn it into something useful, like diesel or gasoline. So I don't like that, but I do like the producers. I like anything kind of heavy equipment that part of the logistics and infrastructures these things build out. I think it's going to be good, and I do like the utilities. I'm going to be a little bit careful and pick around, but I think some of this will do well. I think it'll be a little bit regional, and the one thing we've been eyeing is utilities who will benefit from kind of putting data centers in sparsely populated areas, right? If you look where Bitcoin mining went, right, they were able to use things that were flaring, and they could put the Bitcoin mining right at the source of the energy. I think you'll see a lot more of that going on because you don't really need a lot of people for the data center. You need the energy.
We're still talking about the enablers. We're still talking about the data centers, the chips, the energy providers, the energy infrastructure players. When do we start to talk about the adopters? Is it time to make that shift, that maybe the perceived value might be somewhere else?
Yeah, and I think at some point, right, this should really help U.S. efficiency, so it should be good for the broad markets. I like yesterday, I think Russell 2000 might be too small, but I think the S&P 500 equal weight, that's where the benefit should come. And, some of these innovative companies, right, this was the first time now we've seen, kind of a small startup do something. And we go back to 2020, 2021, when everyone was looking for, the innovators, the disruptors. Maybe we go back to searching for that. Who's going to be out there searching for the efficiencies and stop looking for just the people with the most amount of cash? Look for who has that opportunity for the real multiples of growth.
We didn't talk about the Fed yesterday. Very little. We didn't talk about the Fed so far. The Fed decision is tomorrow. No one's particularly excited for it. They expect it to be basically no change and not a lot of insight. There was a move, though, in the bond market yesterday on the heels of what we saw in the tech space, which was buy bonds, yields lower, inflation expectations and growth lower. Do you think that that has legs, that actually is telling us something about what the ramifications of the tech developments are?
So I think it's telling us a little bit about that. I think we're also seeing a lot of chatter that, rent is coming down. That's probably been the last outlier in CPI. So if inflation's easing, and my big question is, what will they be looking at on the jobs front? I think some of the data has been overstating the health of the job market. When I look at the quits rate, which I think is important to me because it's like a crowdsource where people actually decide whether they want to quit or not. When you look at the impact of immigration, I don't think it's a problem because the weekend, the lower paying jobs aren't that robust. So does Powell stick to the official data, in which case he probably doesn't talk about cutting, or does he hint that maybe the labor market's soft and that puts cuts back on the table? So I think there's that potential, and I think Trump would be all over that.
Equity markets matter to confidence. Deutsche Bank came out with a note yesterday, Lisa, I'm not sure if you saw it, that equity gains likely contributed roughly a percentage point to consumer spending in 2024?
When you have a 401k plan or an investment portfolio and it's doing well, people spend more. That's the reason why OpenAI and this whole boom in tech, some people say single-handedly was responsible for the U.S. avoiding recession.
I'm with Pete, though. There's potentially some good news here. Econ 101, like literally the first class you do at school, is the efficient allocation of scarce resources. If we can demonstrate that we're able to achieve some of these gains without the energy that we thought we'd need, I think that's good news, isn't it?
That's basically what everybody was saying, including Sam Altman of OpenAI, basically saying of ChatGPT, saying, we welcome this. It's wonderful to have a robust competitor. So yes, that's the reason why the equal weights performance yesterday was so instructive for so many people.
It's also why President Trump said yesterday it was positive. It's positive that we can do this on a cheaper front and it can be more efficient. I'm just so curious when this actually starts to seep through to the real economy.
Pete, final word?
Two things, I think. One is they underestimate probably the impact of cryptocurrencies on spending. Crypto's been on a tear. I think people underestimate the political influence it has, but I think it's helped spending, so I keep a close eye on that. And then I do not think the sellover is necessarily done. What scares me yesterday is NVIDIA L, the double-levered ETF, had record inflows. So people were buying that dip yesterday. So I think, yes, we'll bounce a little bit today. It's natural, but I don't think we've seen a washout by any stretch of the imagination. So as this settles in, I think there's more downside, and I kind of watch those leveraged ETFs because they're horrible investments due to how they trade. I do not think the SEC should have approved them because basically the rebalancing causes a drift and you will lose money in those over time relative to the performance of the underlying stock. If you want and own NVIDIA leverage, open a margin account and do it properly. Don't buy these crazy things that have the daily leverage. But yesterday, clearly, record inflows, that tells me the froth is still there.
Tell us what you really think, Pete. Good to see you. Peter Chair of Academy Securities. If you are just joining us, welcome to the program. Equities bouncing back just a touch. We're up by 0.4% on the S&P. With an update on stories elsewhere, here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Donald Trump said that he wants to enact across-the-board tariffs that are much bigger than the 2.5% reportedly suggested by his Treasury Secretary, Scott Bessent. Speaking to reporters aboard Air Force One last night, Trump said, I have it in my mind what it's going to be, but I won't yet be setting it, but it will be enough to protect our country. The president pledged tariffs on sectors including semis, pharma, steel, copper, and aluminum. President Trump is also preparing an executive order for a next-generation defense shield to protect the U.S. against ballistic missiles and other long-range attacks. The order will commission a system similar to Israel's so-called Iron Dome. The White House says attack by ballistic cruise and hypersonic missiles is a catastrophic threat facing the United States. And the world's 500 richest people lost a combined $108 billion on Monday due to that tech-led sell-off. Billionaires tied to AI, including NVIDIA CEO Jensen Huang and Oracle co-founder Larry Ellison, were the biggest losers, with losses totaling $94 billion. Huang on his own saw his fortune fall by $20 billion. That's a 20% drop. And that's your Bloomberg Brief. John.
Danny, thank you. Got a song to play.
Oh, yeah, on my violin.
On a really, really small one.
Okay, no one's going to cry, but at the same time, the magnitude of the declines are pretty impressive.
They're getting richer today. Stocks are back. I'm next on the program. Tariff threats back on the agenda.
And remember, again, the word tariff. We're going to protect our people and our businesses, and we're going to protect our country with tariffs. And we're going to look at pharmaceuticals, drugs. We're going to look at chips, semiconductors, and we're going to look at steel.
That conversation up next, live from New York City this morning. Good morning.
world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Equities bouncing back on the S&P, up by 0.4%. In the bond market, yields a little bit higher, reversing some of yesterday's move, up by 3 basis points. The 10-year 456.47. Out of surveillance this morning, tariff threats back on the agenda.
And remember, again, the word tariff. We're going to protect our people and our businesses, and we're going to protect our country with tariffs. Tariffs on steel, aluminum, and copper, and things that we need for our military. We have to bring production back to our country. The incentive is going to be there because they have no tariff whatsoever. And we're going to look at pharmaceuticals, drugs. We're going to look at chips, semiconductors, and we're going to look at steel.
The list gets longer. Here's the latest this morning. President Trump reigniting threats of universal tariffs on a number of key sectors. Trump pushing back on a report in the Financial Times suggesting newly confirmed Treasury Secretary Scott Bessent favored a 2.5% global tariff rate. The president saying he wants the number to be, quote, much bigger. To discuss, John Lieber of Eurasia Group joins us now for more. So, John, these are the threats. I'll go through the numbers. On Mexico and Canada, 25%. On China, 10%. A warning in there for Europe, the prospect of a universal tariff that's bigger than 2.5%. John, what are you taking more seriously out of everything you've heard over the last month?
I'm taking all these threats both literally and seriously. And I think that you have to look at the behavior of the Trump people so far. They are not afraid of breaking things. The way they've approached the federal bureaucracy and the civil service, the way they've approached foreign aid, and the way they're aggressively approaching countries like Colombia, where over the weekend they basically announced they were going to slap 25 and then 50% tariffs on them overnight. I think that you've got to take all of these quite seriously. It would be surprising to me if they did end up implementing tariffs on Canada and Mexico on February 1, as the president said, but they have laid out a process that they can increase these tariffs by April 1st. And that April 1st deadline is going to be really important to watch because that's the date that we're going to get a number of reports from the United States Trade Representative and really all across the government that lay out Trump's trade agenda and give us clear signals as to which countries he's going to go after and what the tariff rates might be. So the challenge here is you have to take everything he says seriously. And while it does seem unlikely that Canadian oil might be subject to a tariff, you never know with President Trump.
How much is it when it comes to Canada and Mexico that Trump is just trying to bring forward the USMCA renegotiation?
I think a lot of it is that, but he doesn't need to do nearly as much as he's done in order to get there. I mean, the Canadians and the Mexicans have already strongly signaled their intention to renegotiate the deal in a way that's favorable to the U.S. In Mexico, that has primarily to do with Chinese goods and supply chain. They've already responded by signaling their willingness to take deportations out of the U.S. So I do think that, the way Trump has talked about tariffs over the last 2 years and the signals he's sending suggest that he sees values in tariffs above and beyond even their negotiating leverage. And so using them to bring production back to the U.S. and punish these countries is on the table. Not to say it's definitely going to happen, but it is on the table.
The newly confirmed Treasury Secretary Scott Bessent, there's this report in the Financial Times that he is pushing for this gradual increase of tariffs. And it sounds like him because in August, when he joined this program, he talked about that. Xi Jinping, you want to get to 60%? We'll do 2.5% for 24 months when you get and tell us when it starts to bite. Trump said it's going to be much bigger than 2.5%, but he didn't exactly say it won't be gradual. How do you see this team of rivals around him, Howard Lutnick, Peter Navarro, Scott Bessent, Kevin Hassett? How do you see these competing groups win over his favor for what potentially we can actually see if it's February 1st or April 1st?
You know, I think this dynamic is a lot like the first Trump administration, where you had different advisors leaking different stories depending on the day, sending signals as to which direction they would go. But the difference now is that the group of advisors is far more aligned behind the president's vision. So the notable thing about Besant's comments is that the gradual implementation of a universal tariff is considered the moderate position in this administration. That tells you something. And that, I think, is something that markets need to norm in, that actually these policies are being talked about in a serious way, that tariffs are likely going up, that they're looking at doing them universally, even if it doesn't end up being totally universal at the end of the day. But, you know, Besant's talked about this before. Hassett was associated with the plan to do these gradual tariffs in the past. So obviously they're trying to find a way to do the Trump agenda in the least disruptive way possible. But at the end of the day, this is still the Trump agenda. And I think that's what we're going to get here.
John, when we talk about tariffs, at least the initial conversations, we're talking about Mexico, we're talking about Canada, we're talking about Panama, and we're talking about Denmark. Why are we not talking about China?
Yeah, China's a confusing one right now. And, you know, you look at the Chinese have a lot of leverage to get a deal over President Trump if you think that he does prioritize saving TikTok, which he does. And so I think that that's one of the big signals from the early days of the Trump administration, is that they're going to delay a little bit some of this confrontation with China. Trump's trying to make overtures to Xi Jinping. We don't think a deal is possible here. We just don't see the space for the two countries to agree. But it is plausible that the Chinese can string the president along for long enough that the tariff hit ends up being a lot worse than it otherwise might have been. Now, our expectation is that China's eventually going to get whacked here. It hasn't happened yet, but it doesn't mean it won't happen. And after that April 1st deadline, I think we're going to see a lot more aggressive trade action against the Chinese.
Hey, John, appreciate your view, as always, taking everything both seriously and potentially literally as well. John Lieber there of Eurasia Group. Part of the reason we had that big sell-off, I would say the reason we had that big sell-off in the dollar last week, worst week against the euro going back to 23, was because in the first week of the Trump presidency, we didn't get tariffs. A lot of people trying to read between the lines and maybe reading into this too much.
Well, especially because the conversations have been closer to home, at least initially. They've been about Mexico and Canada. Canada saying, why are we getting targeted? Mexico saying, are you kidding, with Gulf of America? And then really people are wondering, what's the real front? Is it going to China? Is it going to Europe? And it's the reason why, again, it's sort of surprising how big some of these moves are.
I would say two things. We didn't get the exact tariffs he was promising on the campaign trail, but we did get a review of wanting to look at the trade negotiations the U.S. has with partners by April 1st, which means this team needs to come up with a plan. Trump is basically saying he has concepts of what he wants to do, but doesn't have it yet. But also, he doesn't have his team fully through the door. Last night, Scott Bessent got confirmed. That's the Treasury Secretary. We're still waiting for his Commerce Secretary. We're still waiting for Jamieson Greer to get there. So he still needs these are all the men in the room to decide what they're going to do on their tariff plan. Doesn't have that yet.
We're only 2 weeks into this. If you are just joining us, welcome to the program. NVIDIA in the pre-market up by a little more than 5%. Equities are bouncing back just a touch. Up next on the program, Matt Bryson of Wedbush following NVIDIA's record market cap wipeout.
Do you think it'll be the case where someday you would be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Stocks are bouncing back. Equity futures on the S&P up by around about 1/3 of 1% on the S&P 500. On the Nasdaq yesterday, closing lower by more than 3%. The biggest single-day decline of the year so far. Bouncing back there as well by 0.5%. If you strip out the muscle of big tech, and NVIDIA, of course, makes up about 5% of the market cap-weighted S&P 500. As Lisa mentioned earlier, I think a lot of us noticed this yesterday, the equal weight S&P was actually basically unchanged on the session, even though you had that big decline on the market cap weight S&P 500. The single name to watch today, of course, is NVIDIA. That bounces back by 5% after the big decline in yesterday's session. A move of $589 billion in market cap, just absolutely unbelievable. And in the bond market, is this a macro event or not, or was that just risk aversion? Certainly in foreign exchange, you saw that risk aversion in the Swiss C and the Japanese yen. We just relaxed some of those moves right now. Yields are higher by 3 basis points on a 10-year, 456.67. That's the cross-asset market action. Let's get you some single name price action too. Numbers from GM. Lisa, General Motors just dropping across the Bloomberg.
Yeah, and it seems to be a beat across the board. Looking at the 2025 adjusted earnings per share forecast, $11 to $12. The estimate had been $10.60 across the board. Whether it's net free cash flow, whether it's net income, that also rising. Net sales increasing. The only miss was actually adjusted EBITDA in North America, and that could be tied to actually a charge having to do with some of the removals from China in terms of closing out some of the joint ventures. So it looks like a beat across the board, and I'd be curious to see how the stocks are performing right now.
Including, as you mentioned, on the outlook as well for 25, the range for EPS $11 to $12, the estimate $10.60. You wanted the price action. Stock is up. It raised in this morning's decline. The stock is positive by 3.5%. GM earnings then just crossing moments ago. Joining us now, I'm pleased to say, is Bloomberg's Craig Trudell. Craig, welcome to the program, sir. What do you make of these? They look pretty decent on first look.
Yeah, solid numbers, and I think the outlook for this year is, sort of for more of the same. I think there's a sort of Cadillac Escalade size, caveat to all this, which is that their forecasts, they don't take into account the potential risk of tariffs from the Trump administration. And I think that's going to be something that, gets talked about quite a bit with analysts today, is kind of, trying to get arms around, just how much risk there is here, particularly, I would say, on the tariffs, that Trump has threatened Canada and Mexico with, because that would be really disruptive even to U.S. car makers like GM and Ford. And so that's something that I think, investors are really kind of braced for and maybe, reluctant to dip into these stocks until they are more comfortable with, just how much risk there is there.
Yeah, CFO Paul Jacobson has a tall task as he comes out before this and says, we've been preparing for that. We've got a pretty extensive playbook. There's another risk here, which is the whole idea of autonomous driving and some of the valuations that you're seeing at the likes of Tesla and questions around how General Motors competes at a time where a lot of people says this will be the vanguard. How do you see them discussing that at a time where it still could be a loss center?
Yeah, I mean, I think they took steps late last year to really kind of wave the white flag, I would say. They decided to basically pull the plug on trying to make the robo-taxi business work, which is pretty remarkable to see, Tesla continue to have, such a valuation premium, despite the fact that they, were quite a bit behind GM's, Cruise unit in terms of actually getting cars onto the road and proving out, the technology. I think GM, managed to make some progress in terms of commercializing that business, getting it to where, they were starting to collect fares. But the problem is that, there's very little sort of forgiveness for mistakes with this technology. When you have a robot in control of a car and something bad happens, in this case, it was another car hitting a pedestrian, and that pedestrian sort of, glancing off another vehicle into a Cruise vehicle. It led to this crisis that ultimately, forced GM Cruise cars off the road, and I really was sort of Cruise's undoing. And so they've decided to fold that business into GM and kind of focus more so on driver assistance systems, and really sort of put off the question of robo-taxis. I think betting that this is going to be something that is going to be a loss center for other companies and going to take maybe a decade or more to really reach scale.
Hey, Craig, appreciate the update. Craig Trudell there of Bloomberg on General Motors. Outward numbers just moments ago. Numbers better than expected. The stock is up by about 2.5%. The outlook better than expected. But how much weight can you put on that outlook? This was a note that came from Bernstein back in November. The note came out and it said GM and Stellantis import 55% of trucks sold in the US from Mexico and Canada. How much weight can you put on the outlook where it's a simple tariff change from the President of the United States can upend this whole business?
It's the reason why you haven't seen these shares really perform, even as General Motors in particular has really beat pretty consistently and turned around in performance in a number of different units.
Stock is up by 2.5%. Under surveillance this morning, the one stock to watch, NVIDIA recovering after its worst day since March 2020. The stock wiping out almost $600 billion in market cap, the biggest single-day drop ever for a U.S. company. The move coming after DeepSeek's cheap AI model fueled concern over U.S. tech dominance.
So Jim Reid over at Deutsche Bank compared the drop in market value as being more than the total market cap of ExxonMobil and MasterCard. You can basically put most companies into that bucket that the one-day drop in valuation is commensurate or superior, surpassing in some capacity. What does this say? Number one, it says how high valuations had gotten. And B, it talks about consensus trades, which is the reason why you're hearing a lot about bubbles in 2000-like behavior and all sorts of studies. I expect the histrionics to maybe die down, but there has been a mentality shift, and it seems like it may not go away so quickly.
The president weighed in yesterday as well. Donald Trump addressing concerns about DeepSeek, calling the Chinese startup's progress in AI a positive. Trump also delivering a warning, saying the company's apparent breakthrough should be a wake-up call for U.S. companies.
He basically wants U.S. companies to be laser focused on this. He says we should be out in front of China. He even said Chinese officials have told him himself that the U.S. has the best scientists. Also, weighing in on this was the new AI crypto czar within the administration. That's David Sachs. He went on Twitter, and he was talking about how Trump was right to rescind the Biden executive order, which he says hamstrung American AI companies without asking whether China would do this